cash.
Yeah, I should do it right now.
Profitability focus, you know, they navigate
Yeah,
through this,
that's
much easier
that.
than everybody else.
See,
Yeah.
you're gonna be directing this.
You know what I mean? Think things through.
That's all right, that's all.
Is this right?
But I do think that
Do you wanna change
in
this?
general.
Yeah, if it needs help.
Is widely
Let me
better
switch
than
the
what the
camera.
media likes to report, because they're looking at the train wreck.
Right.
And,
I mean, I think that's a
hey,
good
things
frame.
went well.
No, you know what, though, it's not level. Like, it's
No,
not-
I mean,
you
it's
see,
mostly
like-
just the emotional, you know, it's the emotional pull, like I said, like I feel like,
This is a good frame, though.
you know, not knowing
This
what's
is like
going
a
on,
good,
human
like,
beings don't go
Soderbergh
down. and
frame.
do
I feel like this, like,
Well, and the thing.
no,
is,
seriously,
No,
doesn't it remind me of,
dominant
like, some,
private
Are there not?
business-driven economy than a public company-driven economy? Well, the only people who have news on are public companies. Private companies don't report their revenue. And you might file a tax return eventually, you know, but it's not analytical. It's on a different basis of accounting than true profit recognition. And so the lack of data from the private business sector is really the big missing piece.
yeah, I
Because
think it reminds me
really
of
about
some.
12, you know, really after the
2010s
we went through this
because you can
significant
see
transition from being
before
a big company dominated to a much more distributed business.
Here, we should probably sit.
There's actually
If we leave this door open, will it be
Yeah,
okay, given that people are,
the business,
assuming people are coming in, but I don't know where.
I don't see any reason why.
It'll be okay, it's not impacting?
Actually,
Yeah, totally. I mean, there's no, we're not, the sound isn't
how
on
many public
Okay.
companies there should be.
to the
Double
viewing audience.
Public companies given the
Good.
economic growth over the last 10 years. But people aren't.
It's gonna be a silent stream. No, I'm just kidding.
And there's so much capital. You don't, generally you went public, you get liquidity. Well, you don't have to go public, you get liquidity. There is this whole new sub-capital group in private equity.
Here, I'm gonna just get the load.
Private equity is probably the best way to put it, because some are hedge funds, some are official private equity. A lot of them are just private businesses that choose never to go public. And to a certain degree, why would you? I mean,
I'm not
scrutiny and all
into
of
this track.
the short-term thinking of, I gotta make this quarter's earnings. It's like, you can't really be adaptive.
I'm really not
You
just
see this, you're just a regular stock price.
I don't want to write.
Otherwise, I mean, think about it like this, how many times is a public company being bought and their stock price changes dramatically because they're being bought? That tells you that the market isn't effective.
see how it goes.
Hey, Joe.
All right, cool. All right, everybody's got everything? All right. Are we good to go, sir? My tech crew is ready? All right. Hey, how are you?
Good, how are you?
Good.
Sign seating?
No, nope, you can, wherever there's an open water, no pads. Your mic, right?
Someone's here? Yes.
Hi, I'm Carol Beth. Nice to meet you.
Hi, nice to meet you. Me, Greg?
Hang on. All right, see.
Oh, there he goes.
See there?
He's gonna sit in the front row. There we go. All right, so welcome. And thank you for coming to CEO Think Tank's first live stream event. In the midst of all that is going on in today's world, I am really grateful to have all of you who are here, as well as those of you who are joining us virtually. And we actually have folks beaming in from all over the world, including Australia. Greg has quite a fan base in Australia. So we've got them too. So I'm saying hello to them even though they're asleep right now. I think they're going to be listening to the recording. I hesitate to spend too much time doing intros because I want to get us started, and Greg has a lot of content to share with you today. But in addition to the clients that are here and our alums, I'm extremely thankful for being, I'm always thankful for being part of our Enlightened Leader community. I'd also wanted to give a special shout out to our live streaming team from the Scepter Pictures, George Hawk and Adam Micheloni, who are in the back doing their thing today. Couldn't have done it without them, and I truly appreciate these Temple University students who are joining us today. So just a couple of logistics, both live stream logistics as well as food logistics. We will be taking questions on the YouTube channel, so please put them there if you're listening in virtually, and we'll relay them to Greg. And he will be stopping at appropriate times to answer them. For those of you in the room, of course, feel free to raise your hand and just ask. I'm going to let Greg moderate the in-room folks. We are going to be taking a 15-minute break at about 10 o'clock-ish or so, around the halfway point. And thanks to my live stream team, the slides are here. The slides should be on the live stream. And you should have gotten the slides as well. So they're in 3 different places. And if you didn't get them and want them, please let me know. And I'm going to be monitoring the channel in the back of the room. So if there's anything else, again, just shoot me an email, shoot me a text message, and we'll go from there. Good? Lovely? Yes? Thank you. So let me get on to the main course for this morning. I'm very, very excited and pleased to have Greg come back to the Philly area for us. He actually comes back once a year, goes to Wharton to talk to them in March, but he's making this special trip for us. Greg and I met almost a decade ago, right after his first book came out, Simple Numbers. And he graciously came then, not just to speak to us about the 4 forces of cash flow and labor efficiency ratios and salary caps, but also to work with several of our clients. Over the years, his curriculum has become a foundational item of the scaling up work that we do. Chapter 13 in Vern Harnish's book, Scaling Up, for those of you that want to look him up. And with recent events, a mandatory ingredient, since it's because of his emphasis on best practices around core capital accounts and paying yourself, not just as an owner, but also for the job that you do, that our clients have made it through this last year and are able to plan for 2021. Thanks, Jill. He's also been my outsourced CFO, although he doesn't like that term, for the past 3 or 4 years, and keeps me on the straight and narrow. And we're waiting anxiously for his book, which I believe will be coming out October.
Middle of October. Yes.
Middle of October. So keep an eye out for that. And I think that's it. So without further ado, Greg Crabtree.
All right, I like to roam, so I'm gonna have to hold on to this all day. So
appreciate it. It's nice to have a live audience to actually talk to. So, but I've actually done 2 in-person events. They just happen to be in Nashville, Tennessee, that I could easily drive to from Huntsville, Alabama. But this, people are starting to get back out again. So I'm going to give you, some of the background there. As Cheryl Beth said, Simple Numbers 2.0 is the long-awaited next book. It only takes me about 10 years to write the next one. The first one took 40 years, and so I'm getting faster, and the next one probably only take 4 or 5 years. But it really is the next stage of everything that we've applied in our consulting practice. A lot of you that are clients of ours, you see some of these concepts every day, but I felt like it was time to kind of put it in a cohesive book that really is geared to a topic that I'm passionate about, because as much as everybody talks about growth and scaling and all those kind of things, we get to see the real data, and the real data is not all growth is good. And so you typically see this in business cycles, and we'll talk about some data that we have access to share with you this morning. But it really is about what is smart scaling. And I think we've uncovered some stuff that I wish we taught in the finance schools, because the reality is most business media, most instruction are around things that probably don't apply to everyday businesses. And we think we've kind of uncovered some of the keys that will help you actually understand that every business that has a viable product offering or value to deliver to their customer has a path to grow and scale their business. The question is, can you then execute? So if we can kind of take the strategy piece off the table so that it can be done, you see patterns of other people doing it, then you're able to actually grow the business. So the book is at the printer. It should be rolling off the printing presses on October the 13th, probably about a week of shipping. So we'll actually be putting up some pre-order pages, both on the simplenumbers.me website, as well as Amazon should actually have a pre-order page. I think my Amazon consultant is supposed to get that hopefully by the end of this month, so those can start going up. But I'm excited about it. Most of the content today is really out of the new book. So the first thing, obviously we're in an unprecedented time. We've gone through recessions. This isn't a recession. This is a restriction. And I wish people would appropriately use the term when they're talking about what's happening at the moment, because the only businesses that are suffering are the businesses that are in some type of restriction, not because of economic woes, because there's a vast wealth of data that shows that there's plenty of winners at the moment, and I'll share that with you here in a bit. But essentially, as we started doing discussions and special webinars during COVID back in March, I think I've lived on Zoom here for as many of you have for the last several months. We kind of broke it down into there's these 4 groups of businesses. You're either unfazed in the sense that things are fine, you feel bad for the people that that are struggling, or the businesses that can't operate, the people who have gotten the virus and maybe lost a loved one, or those kind of things. But you're kind of looking around with survivor's guilt and going, I got plenty of cash, I'm profitable, my employees are doing okay. That's actually the vast majority of the businesses, believe it or not. And I'll share some data about that. There's the bruised. Those are people that you're still able to operate, but you're in an arena or a marketplace that there's just a little less demand. So you're profitable, but you're just not as profitable, and you're kind of in this waiting game of going, it'll be better. You're hoping it'll be better next year, next quarter, whatever the time frame horizon is that you're thinking things are going to get loosened up. Broken but recoverable. These are businesses. I will tell you this. I have seen more business innovation in the last 3 months than I've seen in the last 5 years. The innovation of people looking at their business, changing processes, hiring, upgrading their staff by finding some available people that were displaced by other companies. We've really struggled with an effective labor market in the last 10 years. There's a little bit of glimmer, but it's not going to be there for long. And so, there's tons of people that are upgrading their staff and finding some of those key people, but you better look quickly because they're not going to be there in probably another 3 or 4 months. But these are businesses that they can recover, whether it's through PPP and economic injury disaster loans, EIDLs. We've generally recommended our clients not to take those, largely because if you really read the agreement on the EIDLs, there's some really nasty language. There's some verbiage that people have gotten back from the SBA that they're not really going to hold your feet to the fire the way the agreement is. I don't have that level of trust because there's a legal document that you sign and it's very clear what it says. But really a disaster loan is designed to be one of those things that it keeps you from going over the edge and ceasing to exist as a business, but it means that the first fruits of what you get back, they expect their money back first before you get any benefit. That's the way a disaster loan is designed. It may say 30-year amortization, it doesn't mean 30-year amortization unless you're willing to go 30 years without distributions, without bonuses, without increasing your pay as an owner, because that's what the document says. Now, SBA might tell you something different, I get it in writing. So if you're gonna do that. But we've generally had most of our clients give it back because it's an unnecessary thing. PPP, great program, we'll talk a little more about it here in a bit. But it was huge in terms of getting people over the hump and taking these broken but recoverable businesses and positioning them to be able to survive. Broken and recovery and down, there's a handful of those. Now, in my office in Huntsville, Alabama, we manage about 300 business clients out of that office. We've had 0 go out of business. So there's your good data point. There's been a lot of individual businesses. We had a client that we work with in the managed service provider space, and she was sharing with me an industry trade publication that said there have been 30% of managed service providers go out of business. And I go, no, that it just is, number one, that industry, we have a lot of clients in that industry, they're all doing fine. I mean, everybody needs their IT, so that service need didn't go away. You got some people that might be unable to pay their bills, but not to the extent that you're going to go out of business as the provider. And so I think a lot of people have taken some crazy statistics and just extrapolated them. What you may see is in this last group, you're broken, but you actually have something that you can do, but there's a certain level of capitulation. There's a certain level of people that says, I'm done with this. And so they may close their business and go throw in with somebody else. That's not going out of business. That's still continuing to do business. You're just doing it, underneath, somebody else's cover in that process. So one of the things I get to do is I'm a trainer for the Entrepreneurs Organization Accelerator Program. And so I work with 3 different cities that I've been doing classes with those folks. And one of the questions I've been asking is how is your current activity compared to this same month last year? So we just finished Cash Day for the last 2 months for 3 of the cities. And I can tell you that a third are up over 5% same month, this month over last year, a third are the same, and a third are down. Now these are under $1 million businesses, so these are going to be the more disproportionately affected, businesses out there. But that just gives you a data point in terms of all 3 cities had exactly the same statistical distribution in that process. And so a lot of it depends on what is your business and are you in a restriction mode. But if you're not in restriction, more than likely you're doing okay. We've had clients double their revenues during COVID because of opportunities that they found in those things. So I missed this book. It was widely promoted when it came out. The Obstacle is the Way by Ryan Holiday. But I think it's actually quite a good read for the current time because it goes back to why I say that I've seen more innovation in the last 3 months than I've seen in the last 5 years, because the obstacle of the impact of COVID, the uncertainty, forced a lot of people to get serious about looking at their business through a more critical eye. Yes, you saw it. Even clients that we meet with on a regular basis, give them all kinds of data and analysis and all those things. When the pressure of potential downturn really becomes real, people focus and go into action in a much more severe way. And so, you know, a great quote by Andy Grove: bad companies are destroyed by crisis, good companies survive them, great companies are improved by them. I think you're going to find that most people are going to be better coming out of this than they ever were going into it. And I think the data will prove out that I'll share with you in a second. So, looking back at 08, this is the reason why I say this isn't a recession, this is a restriction. In 2008, you know, what we saw were businesses that had the 2 months cash. This was kind of early on in my development of the core capital target concept of, you know, for those of you that looked at the first book and heard my talks, I'm very adamant that a fully capitalized business has 2 months of operating expenses in cash and 0 drawn on the line of credit. You may have money drawn on a line, and you know, but that's really, it should be there for temporary purposes. So if you have money drawn on a line of credit, you're not at full capitalization, unless it's just an abnormal temporary thing that'll reverse itself in the next month or two. But this kind of became a core philosophy, and I had not written on it in 2008. It was before I wrote the first book. But it was one of those things that I had talked about with my clients. And so when 08 happened, and all the carnage of the recession and everything was happening, same kind of things happening. I'm looking around going, well, you know, I haven't had any clients go out of business. You know, I haven't had any clients get their line of credit pulled. You know, so I finally got a call from a client who's kind of concerned, says, yeah, I see all this stuff on the news. Hey, how do I protect my cash? And even though I saw the data, we didn't have our regular recurring product that we do now on our monthly consulting service back then, but we had somewhat of a rhythm, but I had not started aggregating data. And it was the first time it really dawned on me that my clients had really been listening to me, because they weren't in a state of panic. They were concerned, but they had cash. What followed is that last thing, the profitability, as I watched, this is really what kind of caused me to start paying attention to my client data and doing some data aggregation studies, is 2009, 10, and 11 were 3 of the most profitable years that my clients had ever had. They may not have grown dramatically because it was a recession. It was somewhat of an economy that was trying to heal itself coming out of that. But there was a lot of profit made during those years. And continued throughout the teens in that time frame. And so what we saw was that businesses that had learned to lean on lines of credit, there hasn't been a line of credit issued in the last 30 years that doesn't have an immediate call provision. Do you realize that? You're sitting there thinking that I got a line of credit. You know what? That bank can call you up at any moment and say, you don't have a line of credit. We need that money back. Now what happened in 08 was American Express was a great example. American Express lost a lot of good customers because they had too much extension of credit availability to meet their capital standards. And they had to go to good customers who had never missed a payment, had paid off their Amex card every month faithfully, and they had to cancel those cards because they had to get their extension of credit down below their capital requirements to stay in business, because they came pretty close to going out. And they knew they couldn't go to the people. They knew who couldn't pay their bills. They had to go to the people who could pay their bills and destroy that relationship. But once again, it tells you as the person that uses that credit facility, don't put your trust in it, because it's not always available. And so it really taught me to kind of shift my thinking. Early on in my career, I'm pretty good with math, and so you can make some phenomenal arguments using leverage of fantastic returns on investment.
fantastic cash-on-cash returns, which the real estate industry loves to do. You know, hey, I borrowed $2 million and put $100,000 down, but look at the return I got on that $100,000 that was really the only cash I had in the deal. Well, that math looks pretty good until all of a sudden I don't have a tenant who's paying me rent. And, you know, and where's the cash going to come from for the amortization of that loan? Well, you start hemorrhaging pretty quick, and that's when real estate markets collapse. And one of the things that you've seen, and you've seen this in the news, of businesses that were bought by private equity that got leveraged up with debt. So over here across the parking lot, there's a rental car from Hertz that I drove here. You realize Hertz is bankrupt? You know why they're bankrupt? It's because of debt. They leveraged up, they got bought by a bunch of private equity guys, and they levered them up with debt. And when COVID hits and they don't have cars to rent, it goes south pretty quick because they got too much debt. And so you have to look at these things and say, what risk are you willing to live with? Now, there's some businesses that probably can't operate without some manner of debt, but I kind of came to the conclusion that more businesses could operate without debt, but there's a couple of little nuances that we're going to learn today that I found that it is the development of this will probably be the title of the next book after this one, but I'm really passionate around this idea of the cooperative economy. And as I've gotten to work with some of this data, I think we're in a revolution of businesses and customers working more effectively together, and one not holding sway or power over the other. And those are what we see are the best business relationships. And it really kind of goes back to what I refer to as the speed of margin. The faster that you can take an economic transaction from beginning to end and have the cash flow evenly throughout that transaction, those are the most efficient businesses because it brings the prices down for the end customer. They get the most efficient outcome. It makes cash even throughout, so I have more competitors who are trying to deliver that product or service, and it's a low capital requirement for the service or product provider, so it means that they don't have to raise as much capital or leave as much capital in the business to make it happen. And we've seen signs of this moving dramatically all across the board in the last 10 years. And I really think it's one thing for us to glorify a business who really beats the hell out of their customers or their vendors, you know, but, you know, I'm not a fan of that, never been a fan of that. And so I really think the idea is this idea of the cooperative economy is realistically the distinction between a true first world economy versus a third world economy. I've gotten an opportunity to speak in East Africa as well as the Middle East, and all of those areas, the governments are trying to spur entrepreneurism. And so when I would go in and talk to those groups of entrepreneurs, I'd always ask them, I said, well, you know, this was back just slightly before the last trip I had was back in late January before COVID had started to hit. And I said, well, how's the economy? And he says, well, it's a little depressed. Really? Looks kind of busy out there to me. And I said, well, you know, the government is not spending, they're cutting back spending, and the multinational companies are not spending as much. I said, really? I said, looks like to me there's a lot of stuff going on out there. And maybe you ought to really stop thinking about trying to get the big contract from somebody, having the big government contract, you know, from your government, and then just start serving the needs of the people, because it looks pretty active to me. Come to find out, the governments were actually the worst of all in terms of the payment terms. I mean, there's reports of some of the UAE governments that take as much as 6 months to a year, to pay an invoice. Now they've got, and actually one of the countries, Oman, the EO chapter of Oman, they're going to have me come back and talk to their finance ministry and just encourage them. Says, listen, if you want to encourage entrepreneurism, there's one simple way: just pay your bills faster. And if you'll pay in a normal time frame, you will help spur entrepreneurism, and you'll open the door to more people being able to do business with you in that process. It's as simple as that. You're not spending any more money, you just need to spend it faster in that process. And as you see it there, and then you see it here in the US, like I said, it's really dramatic in terms of the data sets that we've seen in terms of I believe this is what's really spurred the US economy in the last 10 years. We've had a more democratization of private business. There's an article, I think, in one of the business magazines that was about 6 months ago. They were saying, where are all the public companies? So if you take a statistical distribution of the public companies that existed in 2008 and looking at the growth of the US economy, there should be twice as many public companies right now as there are. Do you realize that? It's a shrinking market. The greatest reason why the stock prices are up is supply and demand. There's not enough stocks to buy. There's money going into it every week off of 401k contributions, blindly investing in mutual funds, blindly investing into the finite available pool of publicly traded stocks. You know where the explosion in the US economy has been in the last 10 years? It's all of you guys, right here in this room. It's the private businesses that are in this subsector that you don't need to go public to get liquidity. There's all kinds of cash. I mean, there's never been this much cash in the marketplace in my career. I got out of college in 1978, and I'm telling you, there is a lot of cash. And so it's a new day. We those of us who run privately owned businesses, we are the dominant force of the U.S. economy. But guess what? Does the government have your data of what you've done through August of this year? Do they know what you've worked on? Do they have any clue what your economic outcome is for the last 6 months? Nothing. They might, if they worked at it, which they don't, they might have some idea of your payroll information, but it's a little skewed. They know nothing. I mean, some of you have just filed your corporate tax returns, Tuesday. Well, guess what? I mean, there's so many different bases of tax accounting that even that's not statistical. It's not, you can't understand the true economic impact of looking at tax returns. So this is the problem that we have. We don't have data. I've got data. And it doesn't take an extraordinary amount of data to draw some inferences, but this was the thing that my EO forum, when I joined EO in 2001, this was the damning indictment, so I'll pick on the accountants here for a second. So in my forum, 9 of the forum mates asked them, I said, well, how many of you would recommend your current accountant? And the answer was 0. That's not a good answer. And I said, well, okay, well, why? And I said, well, what is it that we're not doing that you need, you expect from the profession? They said, well, we don't want the tax day surprise, which I totally get that. And as much as we strive with, there's still times that the way the system works, it's a little broken in that there's just too much collision. But we try our darndest to make sure that people are well prepared for what tax is coming. And really, I want you to write a big check because that means you've actually made real money in the process. I know it's painful, but it is what it is. I said, okay, well, I got that. I said, what else? I said, well, we don't like being billed by the hour. We'll come to find out I don't like being billed by the hour either. And so as a profession, our office has kind of changed. We mostly bill on a fixed price basis now. Only when you can't create scope is the only time you try to do it otherwise. And I said, okay, well, I get that. And I said, okay, well, what else? He says, oh, by the way, you see hundreds of businesses' most intimate details. You got to have some idea of what works and what doesn't. And this is the great failing of a profession because we as a profession see all of that information. Now, because of our consulting practice, we see our clients' information every month. So I'm not talking about 2019 when I'm talking about a client's information. I'm talking about last month in that process. So we started doing these data aggregation studies. And so the first ones led to the first book. And so what I'm going to share with you, so we had a 50 company model we were running last year, and we decided, okay, well, with COVID, we probably need to up it to 100 just to get a little better statistical data. So we got 100 companies because our practice is not geographically centric, it's not industry centric. It's a blend of all different businesses all over the US, all different industries. You know, so it's about $1 billion of revenue. So I you know, last time I checked, I think $1 billion is still a significant amount of money. So I think it's a pretty decent statistical representation of what's actually been happening. So what happened? 2018, these companies had a 16% year-over-year growth rate. What did the government report to us that GDP grew at in 2018?
You didn't say you were gonna be quizzing us.
That's right, yeah. I mean, it wasn't 16%, it wasn't 10%, it wasn't 5%. I'm worried about these statisticians in the government because I think they just kind of make stuff up. They're taking little bits of information and extrapolating it, and you know, we've seen that with some of the COVID statistics. You can see that it really produces a lot of distortion. And let's listen, I'm a data guy. Just tell me the truth. It is what it is, but don't make it up. And so this is just hard facts. 100 companies, about average $10 million revenue, but some are $1 million, some are 30 million, you know, but you know, so it's a pretty good average. I will tell you, now this is going to make, you know, different people have different ideas of what happened during previous administrations. I started doing this data aggregation back in 2013 was our first big year that we started doing it under this structure. And so 13 was my base year. 2014 showed a 20% year-over-year growth rate. 2015 showed a 15% growth rate. 16 was a 15% growth rate again. 17 was probably over 20%. 18, as you can say, was down about to 16, and then 19 was down to 7. And the reality is, that's not necessarily bad, because when you're on these double-digit growth rates, I mean, all that growth isn't good in that process. And you got a lot of companies that really needed to kind of clear the decks and get rid of some bad business and reset, you know, and get ready to make another run. So what did we see since then? Well, March, beginning of the lockdowns, this March of 20 over last year was still up 13%. So it hadn't hit economically yet. April was down 17%. May was down 10%. June was up 8%. So that's showing you, we're in the process of updating it through August right now. But from just the general discussion of our consulting team, I mean, I would say July and August are going to be up over last year as well in aggregate. Now, there's winners and losers. There's people that are way up and there's people that are shut. So this includes, you know, one of our clients is a big restaurant. They're, you know, they just reopened after Labor Day. So it's kind of one of those things that, you know, it's a pretty good blend, you know, that process. So
We've got a question. Yeah, thanks.
Yeah, do you find that the data, based on your your client base, could you make the argument that the data might be a little skewed because those leaders are investing in certain way of running their business? They have certain values.
Yeah, I mean, I don't have a way of determining. There again, I don't have a data set of people who aren't following our simple numbers philosophy. I would like to think it certainly helps. I mean, our clients were probably disproportionately better positioned in cash coming into this, you know, than probably the average company. And those things I do believe, you know, really help. But at the end of the day, having that many businesses, it does tell you about the momentum of the economy. You know, and here's the thing. I think we spent the last 5 years largely the recipients of a gift of the market rather than us making markets. And you know, because we can pat ourselves on the back about growing, but did you make a market or did you just take orders? because the market was hot. And we've got a lot of sectors. I mean, if you're in construction right now, you're an order taker. It's like, how many quotes are you not going to take and say, no, I'm full. We were trying to build a pool for the grandkids, and we looked at this project for a couple of years and kept kicking it down the road, and then finally, fortunately, we agreed to go ahead and start it and just finished it. But I was talking to the guys that are doing our pool. They're a year out. They're a year out starting, not completing. They can't, it's gonna take you probably 4 months to get it built, even once they start it. But they can't even start it for a year. And you're seeing this, pretty much all over. Real estate inventory. One of my real estate clients in Charleston, we were having one of our regular calls, and this was right in the middle of COVID, and this was actually in March. And he was asking me, he says, okay, I get asked this a lot because I do like to forecast and look at these things. And he said, well, what do you think the economy's, what do you think, the housing market in their particular industry going to do? And I said, well, given all the factors that we're looking at, I think you're going to have a great year. So he goes and tweets out exactly what I just told him, and I'm thinking I'm having just a private discussion between me and him, and so he puts my neck on the line and makes a public statement. July and August were his highest sales ever by a long shot. The Charleston real estate market is doing just fine, and they're out of inventory. So I got that one right. So, $1 billion in revenue, these companies got $35 million of PPP funds. Now, this is the important part, cash. Cash at March was $59 million, cash at June was $86 million. Now, do you think that's reflective of what the news media is telling you about what's going on in the economy? I have seen the best balance sheets of any time in history that I've looked at, in the last 3 months. So businesses are poised to go act once restrictions are released. Now, granted, there's certain customers that are not going to come back and buy things. I've identified essentially 2 key areas that you're going to see a significant change in. One being the fact that corporate travel is probably going to at least decline 20 to 30%. Because we've all found that, yes, there are certain things we want to get back to in person, things like this, but things like this will always continue with things like this. There's now going to be streaming plus in person in just about every event that's going to be handled from now on. Because our clients who do events have figured out that they can spend less money for event space for the people who truly want to be there in person, but they can sell 4 times as many virtual attendees that they ever thought possible, as long as the content's good. So that industry's changed forever from this point forward. The other one is going to be commercial office space. Every client we've talked to has said, when my lease is up, they're either not going to have an office, they're going to shift to some type of a WeWork kind of Regus type fractional space, or they will restructure their space to probably be 50% or less than what they had. Now there's a handful that can't change, it's just the nature of the way their offices are structured. But in our business, we have 2 offices in Huntsville that are side by side in 2 different buildings. And the first office is more traditional offices for every person. The new office, when we moved in a year ago, it's just an open floor space. So I sit in a cubicle just like everybody else, and I love it. And literally, it gives me less space to leave junk on my desk. Because I still have my office at the other building that is just junk that I just haven't gotten around to cleaning out yet and taking it home. And I think what people started to realize, we're much more plug and play type work environment. We've now all invested in the ability or the technology to plug in and work from anywhere in that process. There's certain days that I would rather work from home now, even though I can go back to the office, because it's just more efficient and I save an hour of between a 30-minute drive in and a 30-minute drive home, and there's no reason for it.
Hey Greg, can you speak to, you were saying last night at dinner about, there is still PPP money available, so for companies that might be listening in or are part of forums that haven't been able.
Yeah, I mean, for the most part, I mean, I think there's some unusual pockets of companies who really could qualify for PPP. We had a client out in California that, for some reason, he just didn't apply. I mean, and he qualified for $115,000 of PPP funds and didn't apply until a month ago. And he's going to be fully forgiven from his because he had the payroll and everything to qualify for forgiveness. So if for some reason somebody thought that they didn't qualify, I mean, they need to, to get with their advisor because, I mean, it's not an incredibly difficult process. They've really improved the application process. I'm impressed. The banks so far that we've dealt with on the forgiveness side have done a good job of building portals and submission of information. So that part's working good. There's going to be handfuls. I got word that from a private investigator friend of mine that he was had been hired to look into some fraud on some of those. And unfortunately, there's some bad actors. There's some people that tried to help people get the loans and take a percentage of the loan. That's just wrong. That's not allowed. But people do it, and but there again, for the most part, the thing about the PPP that I will tell you is, if you have an unbiased researcher 10 years from now look back at it, I think they'll look at it and say, it has some unintended consequences and benefits, but at the end of the day, it was the most innovative thing the government's ever done for fiscal stimulus in that process. I think it's going to be huge. Yeah, Mike.
Greg, do you think that PPP kept us out of the recession?
Let me grab you.
I'm sorry.
On the mic, thanks.
Do you think the PPP kept us out of the recession?
Absolutely, and here's the reason why. So what I didn't tell you about the data was, as we looked at March data, so cash might have been at 56 million, we saw a 10% spike in accounts receivable and accounts payable. And what that tells you is people started hoarding. Now, all you have to do, now 2008 was a recession because it was a liquidity crisis. People stopped trading cash. Everybody held on to their cash, and then everything basically imploded at that point until it got back going again. And so the beauty of PPP is in April, once the PPP funds got released, AR and AP went back to normal. And that's my reasoning of why it was so critical.
Do you think we'll be in a recession in 2021?
No, not at all. No. I think this is a racehorse that's wanting to be let out of the barn, for the most part. Here's the thing, and we can debate, the other piece that I will give credence to is the federal supplemental unemployment and the continuing supplemental unemployment that's there. It's not as rich. We have a weakness in our support systems for government unemployment that it can't differentiate and evenly balance it out relative to what you were making to what you're getting on unemployment. They had to throw a static number, and it created an unintended consequence of people that were making effectively $23 an hour sitting at home. But yeah, I'm okay with that for a temporary period of time, because to a large degree, there's all kinds of stories that I've heard of people I know that were unemployed that were able to they were able to buy a new used car, but that they couldn't have done when they were working. I mean, they had enough free cash flow that they could get their cars repaired or this and that, and those are good things. And like I said, as long as it's temporary and it stops, I'm okay with that. But from a personal side, really right now, because of people not spending money as crazy on discretionary choices, I mean, you're not going to Disney, you're not taking a trip to Europe, you're not flying to this event or that event. I would say there's a vast majority of people that are in the unaffected industries that have more personal disposable income at the moment than they've had in quite some time. And as my mama used to say, if you got $1 in your pocket, it's going to burn a hole in it till you spend it.
Yeah.
And that's the reason why, Mike, I think that's why it's going to happen. People got money that's burning a hole in their pocket.
Okay.
Yeah, sure.
So Janet Castle had a question about the government sector and spending. So again, for industries that are relying on, infrastructure and that type of thing, what's your forecast for 2020?
I mean, my clients who do rely on the government, I've got some in government construction. They are not, matter of fact, they're saying a continual, spend, in road projects, government capital spending. Those are long-term plan things. I don't see either administration, whoever gets elected in November, changing much of that in terms of the spending. There'll be a lot of discussion, but the government's pretty much wired to kind of keep doing what they're doing, in that process. Now, I'm going to play chicken farmer economist for you, because the other thing I get asked a lot is, well, aren't taxes going to go up? We got to pay all this debt. Now, I did grow up on a chicken farm, and I just kind of look at things pretty simply as this is an unprecedented time that every country in the world has pretty much produced debt relative to their GDP at the same rate. If I'm pretty close with my understanding of economics, I think what you'll see in about a year or two is everybody's going to get together, print enough money, and we're going to have a devaluation of currencies that will essentially be no devaluation of currencies because everybody's going to do it, and you're going to cancel out that debt. Now, it's a dangerous thing for people to understand that you can do that. But this is unprecedented because you didn't have one country like Argentina. With my emphasis on cash, I did this presentation in Buenos Aires one time, and these guys threw me a question I couldn't answer. They said, well, they had 20% inflation a month. And I go, that's a bad thing to have cash. And I don't have an answer for you. I'm sorry, I can't work in an inflationary environment like that. But my sense is since everybody was in it kind of at the same rate of debt spending, I essentially the math kind of cancels out. And to get all the countries to kind of agree to it and somebody not break rank, we'll see. But I think they all kind of need it. And I think you're going to see, once the shoe starts to fall, if the U.S., Canada, EU, Latin America, all those countries kind of get together, and work it out, I think that's probably what's likely to happen. Here's the thing. So in the quarter ending June, so the 3 most impacted quarters of COVID, revenue was down 6% for the quarter. Profit in 2020 was at 8%, profit in 2019 was at 9%. You're 6% down and you're still at 1% less profit percentage. And that's during what is supposedly one of the most severe economic events in our lifetime. I think the data's lying to you. Now, airlines, absolutely impacted. Hotels, severely impacted. Try to get a room at a B&B. They're full up. Try to get a room at the beach. Full up. But Hamptons, they're charging $75,000 a month for houses on the Hamptons. So these are things that you've got to take all these things in perspective and say, listen, yes, there are certain things that are happening that are very targeted. If you're in the travel industry, I have a client in the cruise industry. He hasn't sold a cruise this year, but he will sell cruises again, and he'll be in business again. But it's just going to take a vaccine, therapy treatments, better health. This is going to be huge. We've already gotten word. I was talking to him the other day. And the cruise industry are finally accepting the fact that they have to improve health protocols in the cruise industry to win customers back. Now, you got some that'll come back, but the other thing that was happening in the cruise industry that people don't realize, there was about 75 new boats coming online in 2020. Yeah, those guys they're itching to get people back on the boat. And so the marketplace is now going to force them to really step up their health protocols, which they needed to do in the first place, to stop noroviruses and those kind of things. All right, so let's start talking about, the new content. So realistically, I always like kind of simple rules. And so this is really what I lead off the next book with, is the idea of 3 simple rules for business success. And I really do feel like that these are super, super solid for a private business. Now, I don't do work in the public company sector and probably never will. Those people, you know, they like to alter physics, and I like to live in reality. But private companies, what's the first thing you got to do is figure out what the market needs. Now, what the market needs, yes, it's not just your product or service. It is many times the way you interact with them in that process. And so, you know, do they want upfront pricing? Do they want fixed pricing versus hourly pricing? Do they want options to add on? Do they want a tight schedule that you meet deadlines? All of those things matter in terms of how you work with it, you know, in that process. Once you figure out what the market needs, then can I do it profitably? And to me, this is the easiest part for me, because I feel like we can take any kind of business idea and apply, you know, we've got some relevant data set somewhere that we can kind of help people come up with a projected amount of potential profit. But even if you prove that you can be profitable, that's not sufficient. It has to meet a return on invested capital standard. So when I did the first book, I was telling Cheryl Beth last night that at dinner that I said, you know, I like data, but you got to understand there's two levels of data. There's correlation and causation. So data level one, I'm just correlating that data says this is the outcome. Oh, they're correlated. I don't know if they caused each other or not. I just know that they're correlated. But when I can rise to the level of causation of effect, then I'm really speaking with some authority in that process. So in the first book, I just did an observation of, I said, at 5% profit, you're on life support, 10%, you're a good business, 15%, you're a great business, and anything above 15%, take it while you get it, because the marketplace will eventually compete you back. Now, that statement still works for probably about 70% of the businesses, but I couldn't tell you why it works. Now I can tell you why. But I can also tell the other 30% what their profit target is. Because the one thing that we have in looking at all of our data, I've come to one firm belief. A sustainable business in a developed economy, US, Canada, Australia, you know, economies like that, is you need a 50% return on invested capital. So it means if you have $1 million of active investment of capital in your business, so just think equity. Equity is not always invested capital, but let's assume you don't have any non-business assets and you don't have any non-business liabilities trashing up your balance sheet. It's a clean play. Equity is invested capital in those circumstances. So if you have $1 million invested, you should have $500,000 minimum profit target. Minimum. Now the average, depending on industry, can be as much as 75 to 100%. We've identified some industries that their target at full capitalization is 200% return. So, Mike, you know, would you like a CD at 100% interest? Would that interest you? Yeah, I think it would. You know, so you know, you give me $100,000, and I give you, you know, year from now, I'll give you $100,000 back, and I give you $100,000 in interest. Oh, by the way, that $100,000 in interest is taxable. So you got to send 40% of it to the Fed and the state. So you got $160,000. So here's the essential question: would you like to do it again?
Sure.
Yes. Absolutely. You ought to have your head examined if you don't. Now, what the thing is this flies in the face. I may offend some people here. I just got to say it because it's truth.
This is being recorded, Greg.
There could be some investment advisors out there who dutifully are trained to talk to you about asset diversification. Yes, you've got too much money tied up into your business. You need to take some of that money in your business and not use it to grow your business. You need to take some of that money off the table, and you need to invest it with us in the stock market. or bonds or whatever they have you invest in. Now, let me ask you this. If the minimum return on investment is 50%, the average is 75 to 100, why in the hell would you ever take money out of your business and put it in the stock market? Now, there's a point that you've got excess cash in your business. It's not doing it's beyond your 2 months core capital target. You have no ideas on the horizon to invest it in your business to make it grow faster. Absolutely. You take it out and put it in real estate, put it in the stock market, do whatever you want to do with it. You know, preferably do it through somebody's guidance to help you in asset allocation. That money is fine. But I've seen way too many of advisors getting entrepreneurs to try to take money to starve the business from its operating cash as it's growing when you really need it. You're not even fully capitalized. They're getting you even to just bump off the line even to take cash out of the business. That is a dumb idea. And I'm 100% solid on that. But this 50% return, so what really got me, Philadelphia is the birthplace of that idea for me because I get to chair the EO Executive Education Program at EO at Wharton. So it's kind of nice that a little chicken farmer like me show up with actually like real professors and I get to hang out with them and they let me speak a little bit. But I respect the hell out of what they know because David Wessels and Kristen Tershowitz are the 2 lead professors, and I've gotten to know them over the last 5 years. That they do have a wealth of knowledge, but here's what they don't have: access to private company data. First year, David's teaching the class on this return on invested capital concept, and it's like I did that calculation in college. I've never in my years of practice done it for a client in a private industry. And so return on invested capital in the public markets is generally somewhere between 20-25%. That's kind of the general invested capital. Now in the public markets, it's calculated on an after-tax basis because all of those are C corporations. The problem in the private company markets is you have to use a pre-tax number because you just don't know what kind of tax situation those companies are in. So essentially, if you take about a 20% after-tax return, it's probably somewhere closer to about a 30-35% pre-tax return in a public markets case. So I was talking to David and I said, well, hey, I've got access to all this private company data. College professors are kind of busy, so he didn't seem too interested in doing a study, so I decided I'd just do my own. And so as I started studying the data, this 50% return number just kept coming up. And so when you look at a company that's fully capitalized, that becomes the minimum target. Now, not all of our clients are at 50% return because they've got one of 2 problems. They're not fully capitalized and they're not as profitable as they could be in that process. So we start working on that process, and some of them have too much capital invested for what they're doing. So to improve return on invested capital, I got 2 levers. I can reduce the capital requirement, or I can increase profit, or I can do both, and that's even better. And so I'll show you some examples of that as we get into some of that. But realistically, like I said, I think this was the biggest thing that has helped me convince my clients to go on that distribution diet, leave the cash in the business until you get fully capitalized. And it's not forever. And then once you get fully capitalized, we have a concept, we call it the 40-30-30 play. Once you're fully capitalized and you're a flow-through business, S-Corp, LLC, something like that, you can reliably take, as you make profit, 40% will go to taxes, 30% needs to be retained in the business, and 30% can be reliably distributed on a quarterly basis. And you'll probably, I've seen very few businesses that can actually deploy more than 30% of their retained profits on an annual basis. They're going to struggle even to do that. You're even going to probably pop even some of that cash out, later. Yeah, sure.
So two questions. One, because this came out up at dinner last night, you toss off the term distribution diet. And I believe it was Mark Brownstein said, what does that mean? So if you could just,
Well,
give
I
a
mean-
definition of what that is.
Well, and I think most entrepreneurs struggle because they don't have clear guidance as to when is the cash in the business distributable in a practical sense. I mean, you can always make a decision to distribute it, but the question is should you? And realistically, if you look at the cash in your business, you have to say, why is it there? And I think one of the things that has helped our clients retain more cash is we give them a definitive target. So the 2 months operating expenses, that's your minimum, that's as if you have zero cash. So if you've got $100,000 in labor plus overhead, or what we call operating expenses, then your minimum cash balance should be $200,000 at all times in that process. Really simple math. Anything that you don't get terms on. It makes it particularly difficult, like in the staffing industries, because all you have is labor. You don't get terms on labor. And so from that standpoint, you really have to look at that and say that makes a full capitalization of a staffing business a little bit harder. But I'll share a story on that industry here in a little bit in that process. So really, the idea is once you know that you've got that number, the next thing is, are you holding any of the IRS's money or your state's money in taxes that you just haven't paid in yet? Generally, we would like to keep those in a separate account that you identify so that you're not commingling it with your operating funds. And then really anything left over is cash that you can either distribute or continue accumulating for strategic reasons. We've got some clients right now that are in accumulation mode to go buy businesses. Now, I got news for you. In March, there was this brief discussion of thinking, oh, there's going to be some really good deals of businesses I can go buy. Hadn't materialized. There's a lot of expensive businesses that you can go buy. And every client that we've had multiple deals close in the last 3 months, and all of them have been at really, really nice premiums. Because there's plenty of money chasing the same deals. So they ain't no cheap deals to be had. And if there's a cheap deal to be had, you better check to make sure that there's not a skunk in the closet. You might be surprised.
And can you speak to the social sector, because we do have a couple of not-for-profits like listening in, and how this might, these three rules might shift a little bit for the not-for-profit sector?
Well, I mean, certainly the first one always applies. I mean, are you doing something the market needs? I mean, certainly, as crass as it may sound, I mean, for you to raise charitable donations, you've got to be doing something that the market perceives a need, and they're willing to park that cash for that need in that process. A lot of it depends on whether or not you're an operational charity or you're a fundraising charity. So I've got a long history working with Boys and Girls Clubs. I've been on our local board until just a couple of years ago that my travel schedule I just couldn't make board meetings. So, but I still give them a lot of money. And I spent about 10 years in the national organization as a national area council member for Alabama, Mississippi, and Louisiana. And Boys and Girls Clubs are one of the best operational charities out there. But one of the things that had me, get on the national committee was helping them understand how to develop essentially operational business units. So every club is a business unit, and so you could essentially establish models of operation and say, okay, based on the funding that we have, here's the practical model that we can deploy. So you don't try to deploy a $300,000 full service club with an annual budget when you only have committed funding for $100,000. So you've got to match up funding streams to what is actually practical. You've got other charities who do retail, like a Goodwill, that does, there's people that do thrift stores, food establishments, and those kind of things. So those are somewhat operating models that you just have to look at and say, I think the challenge with charities is the fact that you've got to kind of draw a line of understanding. Are people giving you money because they believe in the cause? Or are you transacting business, and that business income is what's helping fund that model. But once again, you still have to do what's needed in that process. And some things, like people that go on religious study tours, those tours are shut down now because of travel restrictions. Now they'll open back up as soon as you don't have to quarantine when you travel and those things. But right now that's a problem for those. Okay. All right. Now, once I've created this profitable 50% or better return on investment business, every one of you, whether you realize it or not, are running one of 3 plays to create value in your business. I've yet to see anybody throw me a play other than these 3. You are either running what we call a run to harvest business. It means that hopefully you're profitable. I don't believe in any businesses not being profitable. But you're profitable, you're cash flow generating, but the market's not going to give you a premium for what you're doing. So here's kind of a basic thing. That money chases easy, entrepreneurs overcome hard. and that is a universal principle. Money is paying premiums for things that do not require a lot of messy effort, guidance, oversight, randomness of operation. Now, you may be good at coordinating chaos. Money does not like chaos. Money likes predictability and reliability. And that's why you see, let's face it, we've all heard the term recurring revenue. Why does money pay stupid premiums for recurring revenue? Because it's lazy. It does not want to manage things. That's messy. You have to deal with humans. We don't like dealing with humans. If we got money, we like to buy our way into calmness and lack of chaos. Those of us that are entrepreneurs, we're pretty good with, that's what we're good at. Now, your goal is, and this is really where, good business coaches like Cheryl Beth and her team are really good at, they're trying to drive you to a more repeatable outcome and take the randomness and the chaos and those things out of that business, because that moves you from a run to harvest business that, quite honestly, you're going to get roughly a 3 to 5 times EBITDA tops out of that business. And even that, I'll give you some examples in a second, but even that, you probably even might have to give some very aggressive terms of waiting to get paid. So it's not to say that you don't continue working a run to harvest business. You can build a lot of wealth in a run to harvest business. You just have to have a different strategy of what you do with the profits. And what I always tell people is, listen, the moment that you require the profit distributions of your business to fund your lifestyle, you're on the slippery road to entrepreneurial hell. Because a business is not going to reliably produce a profit every year. There are things like COVID that are outside of your control and influence. And if you were relying on the profits of that business to make payments on a mortgage, to buy something that continue making other payments or fund your family's trips to Disney World and Europe, those are all fine things. But what you needed to be doing is paying for those things not out of a future promise of profitability, because it's not assured in that process. What you do is you accumulate and then you choose to spend. And as long as you do that, you're fine. And so in a run to harvest business, it really goes back to what I said in the first book. You pay yourself a salary for what you do, you get a return on what you own. Do not increase your consumption on using the returns on what you own, because that's what retired people do, and they're running out of money before the day they die. Well, if you're in your 30s and 40s and even 50s, that's probably a little bit early to be living off of the income of those investments, unless you just got a whole boatload of them in that process. And so that's really the critical thing. Harvest to premium sale is my favorite operating play to run, because then I've got a business that's profitable, cash flow generating, but unless somebody gives me the right number to take it out of my hands, I ain't selling. It's fine. And when you've got the ability to say no, that's when you push the premium up in that process. And then the last one is build to sell. So, and we've had clients that have successfully pulled this off, but this has the lowest probability of success. For every build to sell that works, there's probably 40 that don't, or more. And it sounds great, that you're going to build the next piece of software that charges $40 a month and it'll be great. You might sell a few of them, and then the marketplace is going to be pretty cruel and say, there's somebody else that we like better. Right now, Zoom is the hot kind of deal. Somebody will come in and replace Zoom eventually, although it's still our platform of choice that we like to work off of. But there again, there's a couple of ways to run build to sell, in the sense that a lot of people think of just doing those with investor money. We've had build to sell businesses that never raised a dime of capital. And so there's a technique that you can actually use. I'll share that. So, all right. So here's 3 case studies. So the first one is a run to harvest business. So the example we use here, we've got quite a few clients in this industry, so this is kind of a composite of those folks. So it's a $5 million senior in-home care business. So you got a sick loved one at home. You don't want to put them in a nursing home, and they don't need, nursing skill set around the clock, but you need a sitter. We've had to use these for my wife's father. He was the last one of our parents still living, and he had a bout with cancer, and and we all tried to split up time and stay with him, but he kind of actually liked the idea of somebody else other than us. He wanted to spend time with his girls to have family time. He didn't want them caring for him in his personal needs. And so big industry, does a lot of stuff. Good profit, 12% profit. So this business doing $5 million in revenue, $600,000 in EBITDA. It takes them for them to be fully capitalized. So this is a staffing business. It's just you're staffing caregivers. You got about $1 million to not be on a line of credit. Now the good news about this business is they can keep that capital a little bit lower than a traditional staffing business, because they can actually require payment on a faster basis a lot of times than some traditional staffing industries. And sometimes if you get enough of the deposit up front, you can actually always stay actually cash neutral, and depending on the marketplace and how competitive it is. At the end of the day, this business is worth at best $2.8 million. So there's $600,000 a year, but their value to revenue is about a half, value to EBITDA is 4.6 times. And even at that $2.8 million of value, they're going to have to give some pretty aggressive terms. They're probably going to have to self-finance at least half of that number. And depending on negotiation, trajectory of the marketplace, the quality of your underlying team to the buyer, you may actually get somewhere south. You're not going to get over the 2.8. So why? Well, it's not customer funded, in the sense that, you get a little bit of cash up front, but it's not what you still got to have $1 million of equity. So it's not inexpensive. Secondly, recurring revenue. There are people that misuse the term recurring revenue. Yes, I have a caregiver that is going regularly to a person's home every week. Now you can say that's recurring revenue. No, it's not. That person can drop you in a moment's notice and go find another caregiver that'll be there within 2 hours. That's not recurring revenue. You do not have a long-term contract with them. You have a moment-to-moment contract. You could say sticky customers. The average length of customer engagement in a senior, care business is about 2 months. So not too sticky, because once they pass away, you don't have a customer. Now you're going to get some cases that might go 2 or 3 years, but the average is 2 to 3 months, somewhere around in there. Perceived scalability, very low, because it's one case, one caregiver at a time. One case, one caregiver. Sometimes I have more cases than I have caregivers. Sometimes I have more caregivers than I have cases. It's kind of messy. Great business, but money people will go, it's kind of messy. I don't want to do that. Oh, ability to create? Oh, very easy. You can be in business tomorrow. We have no licensure requirements in those states. So competition, there's a new competitor every week in your space, oh, by the way. So tough business. Good business, but tough business. But there's plenty of people in that industry that I know of, and clients that we have in that industry, that they've made some good income, built some good personal net worth, because they take that $600,000 is over and above what they make in a salary, and they invest it in other things outside the business. That's how they build wealth. The second one, interesting client, $30 million of revenue, $5.2 million of EBITDA, 18% profit, really good business, product business. And so you can see there the value is at $60 million. Now, the initial value was 40, so this was the story I was, Cheryl Beth was referring to earlier. So this client was a regular consulting client, and he hired these really expensive advisors to advise him. He did a competitive deal to go out and sell the business. And he got 10 offers, 7 of the 10 were at $40 million. And so he comes to see me and he says, well, you know, they said we got 7 of the 10, so that must be market value. So that's about 7 times EBITDA. And he said, what do you think? And I said, well, it's not enough. So he looks at me like, who are you? I mean, I'm paying these guys $1.5 million, and you think, so listen, it's really not complex. At $40 million, you're gonna clear $30 million after tax. Here's the essential question. Where can you go invest $30 million after tax to make $5,250,000 a year? That's the question you gotta answer. It's not about the market value per se, it's the question is, what is the value to you? And oh, by the way, 5.2 million on 30 million is 17.7% return. Anybody know where you can get 17.7% that's legal? I don't think that's happening on a regular basis. And I said, listen, I said, I don't know, I'm tired. I said, you're not tired. I said, you work 15 hours a week and 14 of those are not in the office. And so I said, you might be concerned or worried, but you've not told me anything that gives me cause to think that there's a predator lurking to destroy your marketplace. You got really strong repeat customers. You got a great product that they like. If it was me, I'd say you got a great team in place. It's pretty good. I'd keep going because you still own it. And you're getting this 5.2 million is over and above what he still made a full market wage even before that number. So he goes, I don't know. So he goes away. A week later he comes back and says, well, I got him up to 60 million. and really it is this essential thing of a framework of thinking, of going, when can I say no? Now, he's not going to get, you can see it's 11.4 times EBITDA. But there again, the people who wanted it really wanted it more. And how do you know where that number is? But if you can say no, you got a better chance of finding it in that process. You're never going to get 11 times EBITDA for the Run to Harvest business because it's got all those characteristics. This business wasn't customer funded, didn't have recurring revenue, but it didn't have a lot of labor. It had a very sticky customer. I mean, you didn't have contracts, but you had a really high level of customer loyalty, and their product was ingrained in these companies' operating systems. So it wasn't really easy to throw out. There's plenty more room to scale it. So it wasn't stuck. It wasn't at its peak. He sold nationally, so he wasn't limited to a geographic market. It wasn't easy for somebody to create. It wasn't impossible to have a competitor, but it wasn't easy, for them. And so with all those characteristics, he's got to stare into the mist and make a call. And fortunately, in this case, he made the right call. And so that worked out pretty good. The fourth one is the one that unfortunately is in too many entrepreneurs' minds about business, and it's just not truth. But it happens, but you gotta understand the data to understand why it happens. This was a business that was doing $8.5 million in revenue. Now, put $1 million of EBITDA there. The reality is this business had had 0 EBITDA for the last 6 years. Because, oh, you're a tech business, you're in software. You're not allowed to have profit. You have to spend all your profit. And I have to give these guys credit. They were part of the case group that led me to this concept called Launch Capital. Every year, for the 4 years prior to the sale, I would have a discussion with them. And I said, what did you spend money on in this year that had no impact on this year that you spent trying to grow the business? And it was mostly sales and marketing money, and then some tech dev. And so we would isolate it, and that number was well over $1 million a year for the last 4 years of the business. And at the end of the year, I'd ask them, says, what impact did you get from that $1 million that you spent? Because you didn't have to spend it. Nobody stuck a gun to your head and said, you gotta spend this. And they said, 0. And 750 of the million was for the sales and marketing effort. 0. I had a client up in Minnesota that told me that they're going to do about $45 million in revenue this year, and they said that they could actually fire all of their sales team and it won't affect income.
All right.
That's a tough call. But there again, this is what COVID has done, is it's caused people to get in this hyper focus and be real about what actually is causing results. Are you spending money that's not effective? And that's really my big deal in this. Well, these guys were wasting $1 million a year. Now, you don't have to feel bad for them. They sold for $40 million, but they could have had $4 million more, easily. Probably closer to 6. And so, yeah, you don't have to cry for them, but there again, it just highlights this idea of, yes, you got to spend money to try to grow the business, but don't keep spending money on the same stupid thing that isn't working. And all things have a chance of working. So was it your strategy? Was it how you deployed it? Was it too much money too fast? Which, happens a lot. I mean, you get impatient and let's throw some more money at it. If you're in software development, the people in software development know one thing for sure. Adding another body to the project does not speed it up. If anything, it slows it down. And so you got to think through these things and apply this aspect of what I'm spending, what is the expected return? And so we've got a framework that will show you that example called Launch Capital. But in their case, why would somebody pay $40 million for $8.5 million of revenue that maybe at best was $1 million of EBITDA? I mean, that's a 40 times to EBITDA. Anybody got an idea? Why would somebody pay that?
Not a lot of work.
Well, the reality is it's a term that I use. I call it a strip sale. And this is actually most of the time when you see these phenomenal multipliers for a business, they're not buying the whole business. Now, they did buy the whole business, but they only bought it down to the margin line. They didn't need any of the operations. So this business was producing about $6 million of margin. So you take $6 million into $40 million, okay, that's a reasonable time frame of return. Plus the buyer was a strategic buyer that felt like that they could actually move the sales number faster than what the client had. And so most of the time when people are buying businesses, they're jettisoning the operations of the business and they're buying what I call contribution margin, of the business.
So just so I'm understanding, basically they're acquiring the customer base and
the software.
not necessarily keeping any of the employees or anything like that.
They would have kept the technical staff. But
Okay.
but that wasn't a whole lot of people.
Okay.
They didn't keep any of the back office. They didn't.
Right.
They're keeping the people that keeps the servers on, the lights on, and the software, and the people who kind of know, you know, how the sausage was made, and so they gotta upgrade it or, you know, adapt it, whatever. But that's really how the buyers always look at it, is, hey, I can do more with your business than you can. And so they're just gonna carve off that piece, and they'll tell you all this stuff about keeping all your employees, and just, you know, check back with them in about 2 years and you'll see they're not there. And there may be a few that gets absorbed, you know, but that it's not going to operate as an isolated unit in most circumstances in acquisition. Yeah. All right, any questions on this before we move on?
Any other questions?
Okay. All right. So, in the process of simplicity, there's only 3 things that happen in business. You either make stuff, you sell stuff, or you do stuff. That's it. So we get hung up on this idea of, I need an industry benchmark. No, you don't. No. I am absolutely against industry benchmarks for the most part. Because why do you want to regress to?
Say that again, Greg, because we talked about this one too.
Yeah. Well, I just don't like industry benchmarks because it drives out innovation. It drives out disruptive thinking. At the end of the day, you need to be looking outside of your industry for best practices of different ways of doing what you're doing. It's one of the reasons why when we hold our mastermind groups with our clients, we do mixed groups of industries. I don't want people of the same industry. Now, we run some mastermind industry roundtables, but we really push those folks of saying, this is a framework, so don't let it be your benchmark. I want your benchmark to be, what is your world record for whatever critical key performance indicator you're looking at. So think of it like this. Back in the 50s, it was widely believed no human could run a 4-minute mile until somebody did, called Roger Bannister. Anybody ever looked at how Roger Bannister broke the 4-minute mile? It's a very interesting story. You look at, it took about 20 other people to help him do it. Now, he was the only one running, but they went through and picked a perfectly flat route to run through. He had a V of 6 or 7 runners running in front of him to keep the wind off of him. And he had a runner running each mile segment with him to keep him on pace for that mile. So it was all about attacking the challenge of, we got to break the 4-minute mile. Now, I think the current, I think the world record now is like 3 minutes and 30 seconds, 3 minutes, 35 seconds, something like that. We just recently had the guy that broke the marathon record. He ran a sub 4-minute mile for 26 miles. Did the same thing. He had a V running in front of him. They lasered the course, and they had marked it for the perfect path for 26 miles of, because it's obviously not straight, here's where you cut the corner, here's where you cut this corner, here's the best route, so they looked at all of those things. And so at the end of the day, that's really what you should be doing in your business. What process do you need to put in place to be the V in front of your production team to take the wind off of them? What is the shortest distance between 2 points, and have that lasered on the road? I mean, these are all things that you learn in lean processing and Six Sigma, kind of stuff, but it's not rocket science. I mean, it just is thinking of going, how do we make it better? Because if you look at it, people have a tendency to misinterpret industry benchmarks of saying, okay, we're there, we're good. No, you're not. You can perform better. There was an article that just kind of got my goat that came out the other day that talked about U.S. labor productivity gains had stalled. I don't know that I believe that, because I don't trust that they know how to measure it. But and they were talking about the woes of people getting college degrees. Now, I will say that there's a lot of college degrees that aren't worth 2 hoots and for what you pay for them, because they didn't teach you how to do anything in that process. I mean, literally, I've said this to the universities, and they don't like me for it, but if you will just kind of give them like a year of the core classes and just let me have them for the other 3, I can produce a better college student. Because I have to.
Students is on right now.
I have to teach them everything that I need them to know because you didn't do it by a long shot. And that's everything from the industry technical skills to how to be an employee. So this is my commercial for the McClaskey Business Excellence Institute. So there's this group down in Kingsport, Tennessee. It used to be called Powell's Business Excellence Institute, but it's based on this 29-store fast food chain called Powell's Sudden Service. Little 1,100 square foot building. You drive up to the right-hand side, give your order. 36 seconds or less, you drive around the other side and pick up your order. How much time did you spend in the drive-thru last time you were in a drive-thru? It was a whole lot more than 36 seconds. This is one of 2 food establishments in the U.S. that have won the Malcolm Baldrige Award for service and quality. One of the most fascinating businesses that we recommend our clients go to their courses and run through, because you just learn things from efficiency and process, and they have nailed it. I mean, they're just one of the most fascinating businesses out there. David McClaskey was the lean process consultant that helped them do it, and so now he's taken over the Business Excellence Institute and continues those classes. And I mean, it's amazing the productivity gains that they can get, out of that. And they're the highest profit per square foot food establishment in the U.S.
So we had a clarification question on what does IT MSP compare to 3 primary?
Yeah, I'll get to that.
Okay.
Yep. So anyway, from the standpoint of process and gains, though, I mean, these guys are constantly looking for how do we get better, how do we get faster, because they might know what the industry numbers are, but you don't stop when you beat the industry. You stop when you just can't push it any further. The fascinating thing about this group is, so 90% of their employees between the age of 16 and 18 years old. Not exactly, any of you trying to employ 16 to 18 year olds? Most of you are trying to get them out of your house, but you're not trying to employ them. And so in the Kingsport, Tennessee, the primary employer there is Eastman Chemical. So it's one of the remaining profitable industries that are left over from Eastman Kodak. And so they're the prime employer. Eastman Chemical will give an immediate interview for a job to any kid that has worked at Powell's for more than 6 months, because that meant that they got through they didn't get the 4 strikes and you're out concept, because they have this process to where they identify what they call it conditions of employment. And so if out of those 75 things in those conditions of employment, 10 of them are 1 strike offenses. Hey, if you bring a gun into the workplace, okay, you can't work here, you're gone today. But the other 65 are things that individually, they're not fireable offenses. But they've developed this system for clarity of going, if you do 4 of these within a 6-month period, the accumulation of those 4 things says, you're just not committed to what we stand for. And what they stand for is 100% to brand standard, 100% of the time, at 100% volume. Now think about that. Number 1 is, do you have a brand standard that you've defined that you can measure people against? They do. And it's a fast food hamburger, chicken sandwich restaurant. But yet we don't. Secondly, 100% to brand standard, 100% of the time. And so, you can't do it 100% of the time. And David McClaskey, his response to that is, well, you can't say 99% of the time. That's not attaining to an excellent standard. Yes, you are going to miss it sometime. They have 1 customer error in every 3,000 transactions. I guarantee you McDonald's has 1 error probably every 10 in terms of what you didn't get exactly what you ordered and that it didn't get made to the brand standard. And so the fact that they've done that, but the last piece, remember what it said, at 100% volume. So does your business run more effectively when you're at maximum capacity, or is that when all the wheels are flying off the chassis? And see, that's the true measure of an exceptional organization in that process. So you look at that, and like I said, we just love them as an example of people that can make things work. So back to this. You either do stuff, sell stuff, make stuff. You might do a combination. So the IT MSP is an IT managed service provider. So you're IT provider. And so they are a combo. So they do services and they sell you some product. So that they're an example that I put in there for comparison. And so we get into some numbers here. This is the classic example of why revenue should never matter to a business. It's the first data point of math. It really is probably the weakest number on the P&L in terms of relevance. Now, granted, you got to get revenue, but we've had many of our clients that we've been able to strike the word revenue from their vocabulary, and it's all about how much gross margin did you produce. I don't care how much revenue you got. Gross margin, gross margin, gross margin. And that's really the mantra that you've got to have, because you can see these are wildly different businesses across the top. You can see the number gets a lot closer once you get to gross margin. So even though the sales business was $40 million, it's $5.3 million of gross margin. It's actually less than the $10 million revenue business from the service business, that's there. And so one of the things that we've come to believe, and unfortunately, there's not 100% agreement in the financial community as to the structure of a P&L. And so, so when I'm talking to, had audiences of several hundred people, I said, okay, if everybody pulled out your P&L right now and put it on the table, they're all going to look different. So we're all talking a different language. We kind of have some of the same subtotal lines, but they're not all exactly the same. And you call it this, and you call it this, and it's like, why? And so what we were actually able to do is we came up with our simple numbers P&L model. So every client that we have, their data is in this structure. This other operating expenses number is 4 accounts that are combined together for easy presentation, but essentially this is the same subtotal structure that we'll use for every client, every industry without exception. And the goal is to create an ability. The reason why I can give you the report on the 100 company COVID model is because I'm accumulating 100 companies whose data is in exactly the same format. So it's not really difficult. So it's easy to accumulate and compare. So in these cases, you've got gross margin. So gross margin percentages widely vary. 59% for the manufacturing, 13% for the distributor, 95% for the services company, 67% for the managed service provider. I got news for you. We get way too hung up on percentages. If you go down to what's your local grocery store here? Giant. So if you go down to the Giant grocery store, or H-E-B if you're in Texas, or Publix if you're in Alabama, they don't take percentages. They take dollars. Now percentages are important, but they're a secondary measure. It is about the dollars that you generate in gross margin that actually becomes the first significant number, that you're trying to deal with. So actually, let me go to this slide. So the first thing is you're looking at gross margin. Second one is contribution margin. Now, this is the bane of my existence because most accounting programs do not natively do this separation. They're going to call contribution margin gross profit. Direct labor is a component of cost of goods sold. And that is patently wrong. You never, ever, ever mix labor with something that's not labor. The reason being, labor comes to work every day with an attitude. It has a variable output engine. Stuff that's not labor does what stuff does. But labor does what labor does, and it has good days and it has bad days, and it has a lot of days in between. And if you do not isolate labor on your P&L, you will never measure the true productivity of your business model. And so the first one is separating out this direct labor. So then comes the regular questions of, who do I put in direct labor? As a general rule, it is anybody who does whatever it is you do for probably 50% or more of their time. They're facing the customer. If you're a product business like this, the distributor business, that 1.1 million is all their warehouse workers and customer service reps. So that's who would be in that one. The manufacturing business, that's the warehouse, that's the manufacturing supervisors, the field, the floor labor, you know, those kind of folks. The services business, that's all of the billable people that are probably in a services business, in like a professional services model, like, you know, my business. I'm still considered direct labor in the way I analyze our data, because I still spend about 40% of my time in direct billable activities. And so to me, that's good enough that that's actually, and realistically, that's where I want to stay. I'd really rather be in the billable side of things than the management side of things in that process. And so the key is, if you got somebody on the edge, two ways to look at it. You put them in direct if it's kind of the easiest default. But if they're an owner, I might lean to management. If they're eventually trying to get out of doing the production work, then you definitely put them into management labor. At the end of the day, it doesn't really matter. Just be consistent, because it's your number. You're not looking for a direct labor efficiency ratio necessarily that's an industry standard, although we do have some. Yours is saying, on the way, the plays you're running in your business, what is your number? And is it getting better? Is it getting worse? That's all you're really trying to measure it by. And we've had clients that had a 2.5 LER in the same industry. One has 2.5 and one has a 3, and the 2.5 has more profit. It's because of the other things that they're doing. It's just a different way to run your plays. So it in and of itself is not necessarily going to work for you as a singular measure. It's just one of the critical measures. The third thing is DLER, direct labor efficiency. So that's taking gross margin divided by contribution, or divided by direct labor. And so instead of looking at labor as a percentage of something, which is an okay way of doing it, but I found that people feel better when I look at them as a productive engine. So I look at what is, of a dollar deployed in direct labor, what's the multiplier I get in gross margin if they're effective? And to me, that's a much more effective way. Then you get down to management labor efficiency. So the management labor, everybody who's not direct, that number is compared to contribution margin. So we hold direct labor accountable to gross margin, because that's all that they can do. They don't sell it, they just do it. Management labor has 3 functions. They have to drive revenue, manage cost of goods sold, manage direct labor. So that's why we hold them accountable to contribution margin. You never, ever hold anybody accountable to revenue. If I got salespeople, it ain't about revenue. I'm measuring margin. I don't care how much you sold in revenue. What I care about is how much you sold in margin. I was doing this project for a chemical facility that did paint additives, and they were struggling profitability-wise. The father had founded the business, had passed away, his son had taken over, and he had it for a couple of years and couldn't figure out what was going on. So I got called in, and so I spent the first day with the production facility, and I was impressed. They were getting, better cost, with new processes on every line, every SKU that they had, so that was looking pretty good. The second day I spent with the sales team, it took me about 5 minutes to figure out what the problem was. They paid commissions on revenue, and the salespeople could set whatever price they wanted. That's not good. I said, guys, you are never going to be profitable unless you hold your salespeople accountable to margin on the sale and pay them a commission on margin, not revenue. And the son said, well, my dad always did it that way. He says, I guarantee you didn't let him set the price then. There was some other factor that was being managed in that process, and it was just a misinterpretation of how somebody had actually did it. But we're adamant from that standpoint that you never ever pay commissions on revenue. The other piece is then obviously the net operating income. Now notice I've got two numbers here, as a percent to sales and as a percent to gross margin. Now notice the difference here. Manufacturing business is 15.7%. The sales business is 3.3%. Now that doesn't sound too exciting. 11% for the services business, MSPs at 14%. But look at what it is as to gross margin. Then you start to see the real story. Manufacturers at 26%, the distribution business is 24%, services business hadn't really changed. They don't have any leverage. It's all labor. And then the MSP is 21%. I will tell you that profit to gross margin is a far better measure than profit to revenue. It just is. Now there's some other measures that also make that even more important, but that's really kind of the critical piece. All right, so we'll go about another 10 minutes here, and then we'll take our break. So
Yeah, and there's a question around sales labor efficiency as well, and where that fits in, because you've mentioned that in the past.
yeah, so sales labor, if you're in a sales business, so we have clients that sell computer hardware. So they're in a sale, they don't make the computer hardware, they just sell it. So their salespeople are direct labor. But other than you being in a sales business, then your sales labor goes into management labor. Now, what we do is, not on this sheet, but on another sheet, we'll isolate your sales labor and hold them accountable to what? So think about every dollar of labor you spend, you have to ask yourself a question. What's the numerator of the equation I'm holding them accountable to?
Gross margin.
Nope. Lower.
Lower of the P&L.
Lower on the P&L. Contribution margin. Now, the salespeople are going to squeal like a stuck pig, when you do that. But here's the deal. The reason why I hold salespeople accountable to contribution margins is, listen, guys, here's the deal. I don't need you to sell stuff. I need you to sell the stuff we're good at. And it has to be after the labor is calculated for. Because that creates this division of us versus them between the sales guys. Well, we sold it. I mean, you guys screwed it up when you did it. Well, why don't you sell stuff we know how to do? And oh, by the way, you people who do the stuff that the salespeople sell, you might want to love on those guys too, because if they don't sell, you don't eat. We kind of need each other. But if you base your metric off of something that doesn't tie them together, they're forever going to be at odds. And it just makes practical sense. Some systems are difficult to get the labor component in there. I get that. As a worst case default, we do have to use gross margins sometimes where I can't get a labor number in there. But when we're looking at the number with the owners of the business, we're always holding the sales labor accountable to contribution margin, even if I can't do it on a segment basis in that process. All right, so here's the question. Which one of these businesses would you rather have?
Of the four?
Of the four, yeah.
You want to do a vote?
I'll just shout it out. I mean, what do you think?
I'd go with the sales group,
Yeah.
so
So why?
net income,
Yeah. So you're just looking at the dollars.
right.
Now you realize you got to go get
Yeah.
40 million of it. To get that.
Go
So
with do.
Right.
yeah. Which one?
Do.
The services business. Usually that's the one I don't get a lot of choices on, but services businesses are generally more stable and less sensitive to fluctuations in the market. But they're all good. But here's the thing: you don't have enough information. There's a piece of information. You're looking at the P&L. Entrepreneurs are way too biased to evaluate a business's value based on the P&L. It is insufficient. As Eli Goldratt wrote a book one time, he called it Necessary but Not Sufficient. Well, actually, the book was called Necessary but Not Sufficient. It was actually the allegory. It's the same guy who wrote the goal, but it's probably, to me, it's his best work. It's an allegory about his own experience of being kicked out as the founder of a ERP software business. So it's a fascinating story. So it's really about the capital requirements relative to the profitability. That is the essential question that you have to look at to determine which one's better. So what I've done is taken that balance sheet that none of you look at and got it down.
These are our clients. They know they're supposed to be looking at their balance.
I know, but they look at it, their eyes roll back in their head, and they go, I know I'm supposed to look at it, but I don't know what it's saying. The balance sheet is really three things, and I call it trade capital. So this is where we totally screwed up accounting education. I'll argue with any college professor in accounting to my death's breath.
Well, we have some of them on the line too.
Yeah, and so here's the deal. Working capital, you've all got, what's the definition of working capital? Probably have somebody in here that actually knows that definition. What's working capital? People use that word a lot, or that term. Anybody? Working capital is simply current assets minus current liabilities. Does everybody know where to look on your balance sheet to look at current assets minus current liabilities? So it's simple calculation. Every banker since the dawn of mankind has looked at that calculation. They're going to do a current ratio, which is current assets divided by current liabilities. And so are you at the general rule of thumb is are you to 1 or better? Stupid calculation. Here's the reason why. There's two numbers that don't make sense in that calculation, that are choices. They're not mandated by the market. Cash and debt. Most of the time it's just line of credit debt that's on the liability side that's in the current liabilities. You may have the current, if your accountant is really a detail-oriented person, and I kind of complain that this is kind of an unnecessary thing too. They'll put the current maturities, the next 12 months principal payments of your term notes also up in current liabilities. My contention is take all that stuff out. What I'm looking for is accounts receivable plus inventory plus work in progress minus accounts payable, accrued expenses, and deferred revenue. That's everything else that's in there except cash and debt. That's the important number. Trade capital, not working capital. These are the forces of the marketplace that are being forced on you to the turnover aspects of the business. Now, they're being forced on you, but you have some ability based on your strategy to manipulate them. And we'll talk about some of those examples here in a bit, but just for illustration's sake, just think of all of those working capital things excluding cash and debt, because cash is a choice. Remember, you have a choice. I can either put some more in, I can leave my profits in, not take distributions. Sounds like to me nobody's sticking a gun to your head. Those are your choices. Same thing with debt. I can go borrow money. Maybe I could have raised some capital to invest in the business to get it fully capitalized. I just chose to use debt and hope that I got away with it, in the process. So those are things that should be out. Second piece is infrastructure capital. So this is, as I've looked at the proper use of debt, I'm not anti-debt, I just want you to use debt for the right things. And so the idea is infrastructure capital, equipment, buildings, and so forth, proper use of debt, term debt. So you take the net book value of the stuff you've invested in equipment minus the debt associated with it. Very common in the real estate industry. If I go buy a $2 million building and I put down $400,000, I don't evaluate my return on investment for the $2 million that the building cost me. Real estate investors have this cash on cash return. What is my profit off the building, renting it, based on the $400,000 that I put down? That's how they evaluate the return. Yeah.
So Kay has a question. She said, would I add customer deposits to trade capital?
Customer deposits are the same thing as deferred revenue. Yep, in that process. So now that I've taken out fixed assets and then the notes payable, the term debt, now I'm left with buffer capital, cash minus line of credit. Same thing. As accountants, we screw it up for you. We put them on two different sides of the sheet of the paper. It's not about putting them in assets and putting them in liabilities. It's connecting the function of each of these activities. Trade capital is not, it's the net number that matters, not each individual component. I can have wide fluctuations of all of those elements, but what's the net number? So we now calculate on our balance sheet, when our consultants go through the balance sheet, there's a line between the assets and liabilities that's netting out, they're showing you that trade capital number so that you see the net number because it just doesn't natively display easily. Buffer capital, like I said, is cash and cash minus line of credit. And we want that number to be the 2 months operating expenses. So the first three are on the balance sheet, but I said there's 4 needs for capital. Where's the fourth one at? Well, it's launch capital. It's what we talked about earlier, the build-to-sell company that was spending $1 million or more a year in expenses to try to grow the business. I will tell you that 90+% of our clients, the way they grow the business, they're not building buildings, they're not buying equipment. I mean, some are equipment-intensive businesses, but actually very few. Most people grow their business by spending money on the P&L in the current period for something that will take place in a future period. Marketing, labor that is not fully utilized, but you're hoping to sell enough to get that person fully utilized. Software development for internal operating systems. All of those things are expenses. They're not on your balance sheet. But it is the primary source or primary use of capital across all private business. We just not had a way for people to see it. All right, so we're at 10 o'clock. We need to take,
Yes.
how long?
Yeah, so we're going to take, so for those of you on the line, we're going to take 15 minutes at this point, and then we will come back, and if there's additional questions that people have, please let us know. There's a couple of questions in the live stream that I'm going to have Greg look at when we're on break, and we'll come back and talk about, so now what do we do? Since we're all in the same dictionary. Thank you.
Ready to go, guys?
Are we good, guys?
Good, great. So, as we last left off,
I'm back online.
we're talking about these 4 businesses. Which one would you like? There's kind of a random group of choices, and I said, you don't have enough information because it matters about the capital structure of these businesses. And so, gave you this framework. So we're going to talk about, we're going to see the balance sheets of these businesses, but in a much more effective way. So these are the same 4 businesses. So you can see net income at the top. So now let's look at the trade capital of the manufacturing business. They have $542,000 in receivables, $295,000 in inventory. Oh, they've got accounts payable of roughly the same amount of inventory because they have effective consignment, not literal consignment, but they only have to pay their vendors as they use the inventory. So they worked out a deal to improve their capital structure. Now, if they didn't have that deal, they'd have $295,000 in inventory and maybe, $100,000 in accounts payable. That would mean they would be carrying a lot of an investment. This goes back to that cooperative economy concept I was talking about, is when it benefits all parties, there's a lot more terms that can be worked with if people are open to learning about it. Now, so you can see that you got 542 plus 295. They don't have work in progress. They've got accounts payable. They don't have any deferred revenue. So their net trade capital is 542,000. I guarantee you, none of you, unless you're one of our clients, you've never done this calculation. What is net trade capital as a percent of sales? 12.3%. Why does that matter? Because it certainly was not something that they taught you to do in accounting in college. But it is probably one of the most critical numbers to know in your business. Why does it matter? What does it tell you? Well, if your net trade capital is 12.3% of revenue, if I go increase revenue by $100,000, how much more of my money do I have to invest in my business to turn over $100,000? That business is turning, $4.4 million of revenue is what the manufacturing business was doing. So if I increase that to $4.5 million, isn't accounts receivable going to go up? Of course. I got more invested. Those terms change. What I've given you there is an easy way to calculate what, if you grow $100,000, I'm going to produce 13.3% profit. So I'm going to get $13,300 back in profit, but I got to give $12,300 back to fund additional accounts receivable to turn over that extra $1 million. So my net cash flow gain is 1%. So essentially, it's telling you, it's really kind of a shorthanded way of doing cash cycle days. Of all things that you have invested in the business, you take 12.3% of trade capital to revenue, multiply that times 365, that number's probably, was it 45 days? So you got 45 cash cycle days. That you got to have 45 days of sales in cash to turn over the business on an ongoing basis. So this is the thing that challenges most entrepreneurs. Why is it that when I grow and I'm profitable in my growth, my cash is less than my profit? This is the reason why. Now, let's look at the sales business. 3.1% profit percentage. They got $2.1 million in accounts receivable, 2.8 in inventory. Oh, look at accounts payable, 4.2 million. This company was doing a lot less than 40 million, and they went to their vendors and said, hey, if you give us 75-day terms instead of 30-day terms, we can sell 10 times as much. And the vendor said, that's an interesting proposition. Because realistically, they could, at that thin of a margin, you're not going to get a lot of love from the bank. They're going to say one hiccup and you're gone. So they went to a better financing source. They went to their vendors and said, let's strike a win-win proposition. You give me better terms. So notice that their accounts payable not only covers their accounts receivable, it covers almost all of their inventory. This business today is over $100 million in revenue at those same terms because their proposition worked. Because they can turn over stuff really, really fast. They probably have faster than a 12 turns on their inventory. It's get it in, get it out, get it in, get it out. Matter of fact, when you really look at them as a business, they're not a $40 million business. They're a $5.3 million inventory management business is what they really are. Because the products rarely, get cold before they're sold in that process. So you got to understand how to interpret the data. Let's look at the services business. $1 million in profit, 10%. $1.2 million in accounts receivable, $400,000 in work in progress, $1 million in deferred revenue. Now, if this business did not push to collect money up front on projects, they would be in bad shape because their trade capital would be higher than their net income. Whenever you have a company's trade capital percentage to revenue is higher than their profit percentage, they burn cash to grow. These four examples, all of these businesses are all in what we call the cash flow free growth zone. These can all grow without any outside money because they're cash flow positive on every new sale in the process. That is an enormously powerful position to be in the process. And it's become the more dominant situation that businesses have been in the last 10 years. My favorite one is the IT managed service provider. 13.9% profit. Look at their net trade capital, 18,000, 0.7%. One of the reasons why we love this business model. Most of our MSPs actually have negative trade capital. They have more customer money in their hands than they owe anybody, or anybody owes them rather. And so it is an extraordinarily cash flow positive business model in the process. Now, look at the other capital requirements. So we talked about trade capital. These are all those things that turn over up there on your balance sheet and current assets and current liabilities. Infrastructure capital. Well, the manufacturing business, they have investment in some machinery and equipment that net of debt on term notes on CNC machines and those things. So net of 250. The sales business, the 750 is just for inventory automation. So this is kind of where you look at, you can justify investment in automation equipment because it's based on your return on invested capital. So they have about 750 invested in that. Services business, barely any investment. And it's mostly desks, chairs, computers, so forth. The IT MSP, this is an industry that has transitioned from 25 years ago. You had IT MSPs that were hosted their own servers and had a really heavy investment in equipment. Now, they just pass through putting you on Amazon web servers and they don't have any equipment invested. So the next piece is then buffer capital. So this is that the 2 months cash. So you can see $317,000 in the manufacturing business. Well, why is it $317,000? It's the $900,000 of direct labor plus the $1 million of operating expenses. So that's $1.9 million. Divide that by 12 times 2. That's $316,000. So that's how you get to that number. And so the manufacturing business has a pretty low buffer capital because they have a high amount of cost of goods sold that they get terms on. So they don't have to keep that number funded. The sales business, they're just bigger volume, but they've got $646,000. Look at the services business though in terms of the cash that business has. That's the scary part when you are a pure labor business. So this is where you guys that are in the staffing industry, that this is your model. You're looking at a pretty hefty cash number to be fully capitalized. Now, here's the thing. One of the things that really helps that from a trade capital standpoint, though, is one of my clients. We have several clients in the staffing industry, some general staffing, some are very specialized, targeted staffing. And so this had always been a problem for our staffing clients because most of our staffing industry clients have a net trade capital percentage between 15 and 20% of revenue. And most of them are making profit probably in the 8 to 9% range, possibly. So we picked up a client in Australia, and I was looking at their balance sheet, and we're having our first call, and I'm looking at their balance sheet, and I'm going, no, they got a pretty good cash position. Well, they got this big deferred revenue number. They have negative trade capital of like $3 million. So I'm on the call with the founder, and I go, how'd you do that? He goes, well, we asked. Really? You just asked? Yeah, we just asked for money up front. And, you know, and you're not going to get it all the time, and they don't get it on every customer, but they actually get it on probably the vast majority. And it broke through this mental block of saying, oh, well, that's just the staffing industry. And this goes back to my argument earlier about standard industry benchmarks. If you want to be a disruptor, quit looking at the industry benchmarks. Look at other disruptive industries that do similar things and figure out who's doing it best. And so I connected that client with several of my US staffing clients. What do you think happened? They started getting some money in advance. Their trade capital percentage started falling. Oh, by the way, when their trade capital percentage started falling, this magical thing happened to the profit percentage. It actually went up. And so they kind of met in the middle. They broke through not only on the cash flow side of the equation, they were able to be more efficient. They were less constrained. One of the things that holds you back in being at your best profitability is the constraint of cash. If you don't have a good cash position, you're not willing to make bets. And when you have cash, you feel a little better about making a bet about improving a process, hiring somebody that you would like to hire, but I don't know, we're kind of tight on cash, I don't know that I want to hire somebody. When you got cash, you feel a little less constrained, and you're able to make that call. And it's amazing that once people see this pattern, there's this breakthrough that happens. They go, oh, it is possible. Much like I said, the 4-minute mile. Once it got passed, man, they blew through it like crazy, and they're even way past it now. So you can.
Another question.
Okay.
Mr. Longo.
Thank you. We have customers, so we sell fuel. A portion of our business, a big part of our business is selling fuel.
Yep.
We have customers who go on budget plans and sort of prepay into the season. Is that a similar comparison?
Well, yeah, I mean, it is. I mean, probably the best example of that story is Wild Birds Unlimited. So Wild Birds came up with this plan that they have a lot of passionate bird seed buyers, and so they decided that they give you, hey, you can buy a year's worth of bird seed, and we're going to give you this great price, and they're going to buy it in January. Now, do you think feeding birds in January is kind of a peak season of bird seed sales? Nope, no, it's not. But it's great cash flow for them because the first month of the year they get this huge influx of cash. Now, they said, we know that you don't really want to keep a year's worth of bird seed at home. No problem. We'll store it for you here at the store. You come in every month and you get your bird seed, and we'll be happy to help you haul it out to the car. Great. Where do you think they stored the bird seed in the store? It wasn't at the front register. It's in the back. You had to walk all the way through the store to go get it, and walk past everything that they were trying to get your attention to buy something else. The classic thing in retail. Get more customers, get the customers who you're in front of to buy more at every transaction, and then get them to see you more frequently. And if you can leverage those three, those are powerful levers. And so their strategy not only improved their cash flow, it improved their customer engagement. But they touched on a need that their customers really liked. I want a good deal. I know I'm going to buy a year's worth of bird seed because I'm a passionate bird feeder. Great. Let me help you with that in that process. So any of those things that you can do, you're getting those commitments. The challenge a lot of times is how much of a discount do I give, for that? And that part, there's probably just not a lot of clear guidance, of what, there's a point that it's got to make sense for that person to pay it all up front. But here's the clue about getting paid up front. If you're working with a large corporate buyer, do they have cash? Of course they have cash. It's not a problem about them paying. It's a problem about when they pay. So why do they take time to pay? Well, in the old days, it was because you could actually make money on cash. Today, you ain't making nothing on cash. And realistically, it's more about, is it in their budget? So when a customer uses the word budget, it is your clue that they probably have the cash. You can probably get them to pay you earlier because it's in the budget. It doesn't matter when they spend it, it's in the budget. It just has to be in this budget year. So those are the easier ways to look for those clues. Otherwise, you're trying to have to give a discount and say, how can I lure you into doing it? My software client, they sold mostly into the higher education industry, and they actually would get 3-year upfront payments for their software because it was in the budget and it was simpler to write one check instead of writing a monthly check over 3 years. Now you wonder why we might have a budget crisis in some of those institutions, but it's just kind of how the game is played. So.
And so one other question on the chat, contribution margin, is that the same, there's not really a target per se again, Greg, for that?
No, the target is contribution margin dollars is the most important number on your P&L because it is.
Say that again?
Contribution margin dollars is the most important number on your P&L because it is the output of your productive engine. Now, I don't really care what the percentage is. You can draw inferences from the percentage, but there again, I might get one deal that has a higher percentage, but it's lower dollars. I got a bigger deal that is, higher dollars, lower dollars and a higher percentage. I mean, so it can go back and forth either way. It is about generating the dollars there relative to the infrastructure. So we call operating expenses the business chassis. That's, so do you have too big of an engine being driven by too small of a chassis? More times it's the other way around. You got this big chassis and a pipsqueak engine that just can't pull it. That's why you're not profitable. And so you got to get the two aligned. And you got to be able to add capacity in both parts of the business model, as demand increases. Okay? So here's the big key. So we got through all this. You can see the required capital. So think about it like this. A $4.4 million manufacturing business needs $1.1 million of invested capital to turn it over and do what they do. Well, that means that for $1.1 million invested, $585,000 in net income, that's a 52% return. Anybody want a 52% CD? I think yes. I think that's good. All right, sales business, $1.2 million of net income, $2.1 million of required capital. Now, granted, if they didn't have those special terms with the vendor, notice what would happen. If you take $2 million, you had $2 million for that required capital to make that $4.1 million and $1.2 million, then they're at 25% return on invested capital pre-tax. That ain't exciting. That is a crater looking to happen. So they had to bend the curve of trade capital to make that business viable. And if those terms ever disappear, that business is, if they can't increase profit to match the capital requirements, they're going to go out of business. Simple as that. Services business, same thing, 51%. If they don't get the $1 million of deferred revenue, now most service businesses, this is based on a professional practice model. Most professional practices suck out all the cash at the end of the year and live off the lines of credit. And that's a reason why there's a significant number of large law firms, accounting firms, engineering firms, architectural firms, medical practices that dissolve periodically because they're living too close to the edge. They don't understand that the business entity itself is required to make a profit based on the capital invested. And so we've actually turned around quite a few law firms and medical practices under this concept. It's foreign to them to the beginning, but once they get a hold of it, they're far more effective as a business to start running it more like a true corporate entity, that process. Now, here's the MSP model. 293,000 invested, 352 in profit, 120% return. So Mike, would you like 120% CD?
Absolutely.
Now, here's the deal. These numbers that you're seeing on the MSP, this is actually from a mastermind group that we run. So this is the average of the group. If you really want to be out of 15 companies in there, if you take the best 5, what they have is their profit percentage, average profit percentage is 25%, and the return on invested capital is over 200%. That's the reason why you don't want to use an industry benchmark. You would underperform. The best of the best do 200+% return every stinking year. You had a question, Sherman?
Yeah, there's an ongoing conversation. Mike Maxon is actually answering questions on the live stream for
Oh, good,
people.
good. Yeah,
That's all I'm
Mike,
saying.
that'll be good. Mike can keep that. So this is kind of the chart that we came up with to drive this point home. Think of, if you look at the trade capital, you probably don't have your balance sheet in front of you, but if you go back and look at your trade capital, take it as a percentage of the last 12 months of revenue, and compare it to your profit percentage. If your profit percentage, your trade capital percentage is at 10%, and your profit's at 5%, you're going to burn cash to grow. If your profit percentage is at 10% and your trade capital percentage is at 5%, grow as fast as you can, because you're going to have cash. You don't need any outside funding. You don't need any expansion of your line of credit. Go for it. It's execution at that point. Okay. So this to us is really the key. And once people see this and we show them where they plot on the curve, you got one of two choices. Can I bring trade capital down with better terms for customers, better inventory management, better vendor support, deferred revenue, getting paid up front? Or do I have to push profit up to match that trade capital requirement? This is the essence of private business. And if you can get it to where you're self-funding, you got the power to say, listen, if you don't pay me a premium price for this, I'm just going to keep it because it's a good business.
And that was your point about becoming more efficient, so it's like shrinking that cycle time, right?
That's right.
And-
Exactly. You know, because if you're a construction contractor, think of it like this. You know, because most construction projects have probably doubled or tripled in length of time from start to finish. That means there's a lot more cash in the cycle. Even though that you can get, you know, some draws and things like that, your final payment is sitting out there for a lot longer on those kind of projects. And so you just got to find ways to break through. And it's COVID has actually opened the door to a lot more people not being as rigid on some of these terms and conditions. We've actually had governments that broke through all the paperwork and did projects. One of our clients actually here in Philadelphia, I mean, they sold a significant amount of medical support equipment to one of the states and broke through all of the barriers. They got paid up front, you know, for a couple of the pieces of equipment, so they were never out of pocket on any of the cash flow. But it's the unique times. But they knew, because we had educated them on this concept, they knew to ask for those terms. Yes, ma'am.
Oh, sorry.
We got another question on S corps.
Did I go first?
Go ahead, and I'll get covered.
So one of my largest vendors, the terms are 2%, 10, net 60. Is it the old, I've always deferred to, you just take the terms. But since it's net 60, would that be worth looking at?
Well, I think you got to look at it and say, I mean, certainly, so look at it like this from a standpoint. If they're going to give you, is it 2%?
2%, 10, net 60.
Yeah. So, you know, realistically, I mean, that 2% discount is an improvement of margin.
Mm-hmm.
So I'm almost going to always do that, you know, in that process. But what it means though is I just need to up my capital that I have in the business to be able to turn that piece over.
Okay.
So that, I mean, that's the way I solve it, but I'm getting such a boost in margin percentage, it's well worth it.
Right.
Because that's effectively 2% 10, if you really look at it on a day's calculation, that's almost 50%, that's 50% return right there
Right.
on my investment of turning over that cash.
Okay.
And there was sorry, I'm throwing this in because I think there might be a complication. I thought S corps were supposed to take their profits out at the end of the year.
No, that's
That is not correct. That's
a
a fallacy.
absolute fallacy. You will be taxed on the profits whether they stay in or not. That has nothing to do with it in that process. That's an entrepreneur's excuse that people use to take distributions that they should have left in the business. So here's an example. So we have some clients in the snow removal business. Great business, but you gotta rely on snow. But here's an example. So they have $5 million in revenue, net income of $595,000. So their capital structure is they've got $250,000 in trade capital, $300,000 in infrastructure capital, about $589,000 in buffer capital. So they have $1.1 million invested in the business, so they're getting a 52% return out of that particular business model. So some of ours actually perform much higher than that, actually. But this is a good, sample of just an industry example. So what you're doing is you're just really extracting, like I said, this trade capital, infrastructure capital, and buffer capital is everything that's on your balance sheet. It's just netted. So I'm not looking at a left and a right or assets and liabilities. I'm taking the functional items of the balance sheet and connecting them together so that they actually make more sense. Because there's only 3 things that your balance sheet does. I got my turnover stuff of terms, and I could be either positive or negative depending on my terms. I've got my stuff that I own, my facilities and equipment, net of the debt. And then I've got cash. And that cash is either leveraged, I either have cash because I've got line of credit, or I may be net negative, I may be leveraging using line of credit to fund some of those trade capital items. But that's every item that is active in your business. Now you may have some accounts left over. And this is what Professor Wessels taught the group at the Wharton class. He said, return on equity is a flawed calculation in a public company balance sheet, because there are things that are not invested capital. And we have some clients that have private equity investment, and I have to do a clean return on invested capital calculation because the company that invested in them put all of these intangible assets on their balance sheet. You can't sell those. That was the investor, put those. So those don't count in invested capital. I've got to look at active current assets, current liabilities, and I've got to look at active equipment and debt. Other things, intercompany loans, shareholder loans, and those don't count. Those are non-business assets and liabilities. So you leave those out of the equation. But if you're running a clean balance sheet, the way we want you to run it, actually equity will be the right number that you can use. So, all right? Make sense? So, let's talk about the magic pixie dust of business. This is really how 90% or more of your growth is going to come from. It's not about other things on the balance sheet. Now, I still want you to get your cash. Once you get that cash number, you can now afford to go to the craps table and stay in the game long enough to win. I learned a lesson a long time ago. I was at a conference in Vegas, one of the places that I don't really go to very often, and I said, okay, I kind of read up on craps, and it supposedly had better odds in some of the games. And so you got to have enough money to stay in the game. I lost $300 faster than I could blink. And I realized pretty quickly that it was a game that you had to have a stake to stay in. And one, it moved way too fast for my ability to keep up with it being a novice. But I understand the principles of it. But there again, it is that thing that you will get down, but the basic odds say there's a good chance you're going to get back up as well. Well, that's really what launch capital is too. You're going to make bets. And, you know, so, I mean, what's some bets that you guys have spent money on, hoping that it would grow you didn't need to spend it at the time to take care of the business that you had. You spent it to get business that you wanted in the future. So what's some examples of the folks here in the room?
Live streams.
We didn't have to spend a whole lot. Well, you got some people. You invested in some people doing that. What's some things that you've invested in?
Sales reps?
Sales reps, exactly. One of the big things.
We hired like 6 or 7 during COVID.
Yeah.
Just
Now,
for some
do all those sales reps succeed?
Probably not.
No, they don't. But you're hoping if you just get one of the 6 to work, you've done fine. Now, the idea is, we had a client years ago that kind of drove this idea home. He was a location-based medical equipment supply business, and he was trying to open up, and he had 3 successful locations, and he was looking to add a 4th location. And so he tried one in one city in Alabama, and we had modeled out that it was going to be $150,000 for him to open this location. And so he opens it, and about 3 or 4 months in, he realizes this isn't going to work. There's political issues of working with the hospital, one thing or another. So they kill it, and they only lose $75,000. So the nice thing there was they realized they didn't go 150 in and waste it. They stopped it as soon as they saw it wasn't going to work. Pull back, looked at another location, tried it, got about $60,000 into that one, and go, nah, this isn't going to work. Just pull the plug. The next one they did, that location produced over $1 million of profit for about 7 or 8 years, a year. $1 million a year for a $150,000 investment. And that's really where the good high leverage returns are going to be, but you're going to miss. Now, you learn something every time you miss and say, why did we miss? What are the characteristics? What am I missing? What are those things? Sales reps, when you hire sales reps, you go, I will tell you, I mean, unequivocally, the #1 hardest person to hire for your business are salespeople.
Say that again.
The #1 hardest person to hire is salespeople, and we're big advocates of the hire slowly, fire quickly. As soon as you know, I have a standing rule when a client tells me they're going to hire a salesperson. I say, great, I'm going to mark that on the calendar. I'm going to call you in 30 days. Now, in 30 days, I will bet you that you will never ever be wrong. Whatever you think 30 days from the date that person starts, I don't care if they've sold anything or not. In 30 days, you're going to be able to see, are they going to make it? And you need to make a decision 30 days in, we need to go back and fish another one out of the pond, or let's just keep going. And I don't think you're ever going to miss. Every time I've done this with a client, one of my EO friends tells me, he says, when there is any doubt, there is no doubt. And when I hear that hesitation in your voice, so there's doubt. Well, you probably need to go back into the pool and let's fish another one. And so, but there again, you've got to do it, or you've got to find. Now, one of the things that I'm a huge fan of that I've seen, we've had success with it, our clients have had success with it, is more of a process selling. So any of the marketing firms here and the ones listening will appreciate this. So we have forever had this terminology backwards. We say sales and marketing. That is incorrect. We should always say marketing and sales. You cannot do sales without preceding it with marketing. And it is really, I contend, far more important to have marketing effectiveness and then turn sales into a process of scoping and closing, which is really more of an account management aspect, rather than this coercion of an insurance agent using no as a precursor to just saying yes. I mean that world of selling has gone the way of the dodo bird for the most part. Now there's some industries that still have it, but I even think they will eventually evolve out of it. But if you can do an effective job of communicating your value, benefits, features, and touch the needs and the pain points of that customer, You don't have to do any sales. It's about when and where and when and how much. And let's get all those details worked out, in that process. But there again, I mean, most of us that are trying to hire salespeople, I may offend some people. It's what I call Cro-Magnon selling. I mean, it's the thing of I've shoved marketing and sales and customer management into one human, and I've just created one central point of failure. That person is communicating values and benefits. They're trying to scope it, close it. They're trying to do a customer management, and they might be good at one of those three, but they're never good at all three. And you've got to evolve into a much more elaborate process that is I believe, far more effective. But sometimes sometimes the painful point may be if your sales are suffering, it's not your sales or marketing efforts that are causing it. You may be missing the mark of what the customer needs. And you've got to go back and look at that piece first and say, why is somebody succeeding, somebody else is succeeding and you're not in that process. But marketing is definitely the number one thing that we look at in Launch Capital. I call it the black art. There's not science. I mean, you can kind of throw some science in there maybe, but marketing is really one of those things that we're huge fans of. It's really hard to find effective marketing, but don't be deterred. If what you did didn't work, you gotta try something else. You just gotta keep working at it and finding helpful resources and those things. But marketing, labor, facilities. Now, what you do is once you identify this, what we call the catalytic spend, then you evaluate. So let's say I'm going to risk $100,000. Then what you have to look at and say, well, I'm risking $100,000 that may or may not work. What is the picture of success? There's a friend of mine in the software development world, he has a term that I love. He says, what does done look like? And what done looks like says, profit has increased 50% of what I bet. Now, when I say profit has increased 50% of what I bet, that means I've recouped my cost and made $50,000 on top of that. It is not sufficient to spend $100,000 to then have profit go down $50,000. Oh, I did get some sales. It ain't about sales. It ain't about margin. It's about profit. And if your profit didn't increase from your marketing efforts, you got sucky marketing efforts. You got to go back to the table and figure out what's wrong. So once you establish this, and the idea is that return generally needs to occur within 12 to 24 months in that process. So the best example of this is a story that I get to tell. There's an EO member in Omaha, Nebraska that I don't do his work, but I'd heard about him when I was there doing a speaking event, and he runs a transmission repair shop. He's got 15 of them. He actually manufactures transmissions as well, but this segment of his business is just repair shops. I said, well, Pete, let me use you to explain this concept to the group and see how close I get just guessing what I think your numbers are. I said, so you're thinking about opening the 16th location of your transmission store, so my bet is you're going to spend about $1 million on the dirt in the metal building to get open. He goes, yeah, that's pretty much our budget. I says, okay. So you're probably going to have to put $200,000 down, and the bank will finance $800,000 over a 15 to 20 year term note. Says, yep, that's exactly how we do it. Good. So that first $200,000 of down payment is your first capital input. Now, my guess is you're going to spend $200,000 in opening cost and operating losses until the store has its first break-even month. He paused and goes, yeah, that's actually exactly the number we use. He says, good. You can tell I've done this before. So now you got $400,000 of capital input. Your go, no-go decision on the 16th location is, can you convince your team that you can get to $200,000 a year net profit run rate, which is $16,667 a month, by the 12th to the 24th month once you open? That's it. So he paused and he says, well, that's kind of interesting. says, what you just told me in 2 minutes took me 30 years to figure out. And I'll tell you, I look for patterns that recur in the universe. This is one of those recurring patterns. This is it. It's not rocket science. There's a practical reason why, and it goes back to the 50% return standard. If you can't get a minimum 50% return of your capital invested, it's a bad idea. Unless you got more money than brains, why would you do it? And most of us don't. So you got to have this framework. Now, it may not work, and you're going to lick your wounds and go try to find something that is going to work. Most of these actually will return closer to 100% return. That's really kind of your goal. Yeah.
So we have a question on the live stream from Daniel Craig. In a startup context, would you consider sweat equity to be a type of launch capital? And if so, how would you get that to show up on the financial?
Yeah, sweat equity is one of those I do recommend startups actually look. We don't work with as many startups today as we used to, but it's still a valid idea. But here's the thing. In the book, I do discuss the concept of how to account for sweat equity in the new book. And I want you to book it, and I tell your accountant that you booked it so they don't screw up your taxes when they file it. But as soon as you take the first dollar in distribution, sweat equity is irrelevant. It disappears. Because your ability, for you to be able to take a distribution, by default, you have retained enough profits through retained earnings to allow, you've now built your capital that your sweat equity was the placeholder for. So that's how you got there. But it's not a forever thing. It disappears once you've retained enough profits and replaced it with cash.
And the follow-up question on marketing is, would you, if you were hiring a marketing firm to help you, would you be sharing this idea of launch capital with them?
Absolutely.
Saying, this is the investment I'm making, and therefore these are the outcomes I'm expecting.
Absolutely. Now, we have a hard time, you could have an issue where one of the two parties might be not comfortable sharing, because it's a very uncomfortable requirement, but it's necessary. And so our marketing clients would love to have this data, because they would love to have the data to prove the quality of their services. They only have to get empirical information, unless they're working with a public company. But there's times, though, that there's marketing companies that are more sizzle than steak, that they probably don't want to look at that data either, because they're basing it on, oh, look at how much revenue increased. That's not, your eyes are on the wrong thing. It's about effectiveness at the end. Right, so let's look at a live example. So this is a client case study. We started working with this client back in 2012. They did $700,000 in revenue. So their whole goal was to grow their business through increased marketing spend. So every month, our consultant, Brandon Gray, would meet with them, go over this number, but they committed to, instead of spending $75,000 in marketing in 2012, they were going to increase it by 120, not take it to 121, increase it by 121,000. So it quite simply means their new net income target for minimum acceptable performance is 50% of 121,000. So they need to have profit go up from 63,000 to 124. Now, personally, I would like them to be higher than that in profitability, but I'm really just focused at this point of going, is their additional debt effective? And that's really kind of the key thing I'm looking at here. Well, what happened was they got close. They got it to 118,000. Now you can see, I mean, this is kind of the case where a marketing firm would look at this. Oh, look at this! You spent 121,000 additional money, and oh, look, you got a 1.3 million dollars in new revenue. Big whoop-de-doo. By the time you get down to the bottom, we only went up, probably 55,000. It ain't about the 1.3. It's about all the other. Now, these other costs did go up. The reason why I don't include those is they are reactionary costs. They were a response to the catalytic spend. They weren't the prime spend. Once I spent the catalyst of the marketing money, it caused growth. And in this client's case, they were able to backfill the expenses as they knew they had the revenue. But they still felt pretty good. 45% return on that bet. That's still not shabby. It's not my 50%, but it's close enough to say, all right, let's let's try this again. So they said, okay, well, let's add 103,000 more and keep going. So now they got to go from 118 to 170 in profit. Well, they blew it out of the water. They hit 628,000 in profit, so 493% return on that additional bet. Now, I accept the fact that some of the growth in 2014 of the high profit year was stuff that was the latent effect of some of their initial marketing efforts. Now, it depends on the kind of marketing that you're doing. Some marketing is for the moment, and if it doesn't work, it's gone forever. Other things linger.
Yeah.
It kind of depends. Nobody can tell you the direct correlation, but they're looking at it going, hey, that's pretty good. And so this is where entrepreneurs are their own worst enemy. They said, hey, what's this? If a little bit's good, a lot's got to be better. Let's light this puppy up and throw some gas on the fire. So this is where entrepreneurs kind of become participants in the Darwin Awards. And so so they had 394, and now our new target's 825. Whoops, it didn't work. Now it didn't kill them. Fortunately, they were a Darwin Awards runner-up, and they didn't win the award. Now actually, these are good guys. They really did a great job. They got their money back. It hurt, but here's the thing, and this is kind of one of my key messages about marketing. There's two ways to approach marketing. Do you want to take a leap to try to find the edge of the universe, or you want to take one step at a time? I kind of like one step at a time, because if I take that step out there and I don't feel anything underneath it, I might not step. But if I leap, there is no testing. It's gone. So what they learned was two things. What used to work had ceased to work as well. There was a point that spending more was just like pouring cold water on the desert, not going to make an impact. It's just a waste. And so they said, okay, we learned our lessons, we're going to moderate, we're still committed to growing. So they spent 166 the next year, got a 91% return, spent 154 additional the next year, got a 286% return. So this is a business that grew from 700,000 to 10 million in 5 years. Profitable every year along the way, did not use a single dime of outside capital. Now think about it this, if somebody's talking about growing a business from 700,000 to 10 million in 5 years, what's the first thing they're thinking about? Oh, I got to get investors. Why? This business was cash flow positive every year along the way. It was about making the right bets to grow. Now, they moderated, look at direct labor. Direct labor was around 6 to 680. We knew, so our consultant who was working with them, Brandon, was going over, they were struggling to hire as fast as they could in the direct labor in 14 and 15. So the direct labor shot up. This is what we call running hot. So when direct labor abnormally shoots up, when we see a jump from 682 to 814, the first question our consultants ask is, hey, how's everybody on the team doing? Oh, they're a little stretched. Good. Oh, you need to backfill. That's great. You can see in those 2 years, 17% profit, 11% profit. They were very profitable, but they were running hot. They were burning their people out. They got back to normal in 16 and 17, and were in the high sixes, was where we had patterned out their optimal direct labor. Now, in 16 and 17, one of the things that kind of dropped their profitability down was their management labor efficiency. In their case, and this is actually a fairly common number, so direct labor efficiency ratio, it's all over the place. There are some common elements that we can kind of share with people, but it is very dependent on your business model. Management labor efficiency, though, has a pretty tight correlation that once you're over 5 million of revenue, you probably should be above a 4, and between 4 and 5 is kind of where the optimal place is. Just is. There's some business models where, you can cheat a little bit and have a very thin management structure, but in their case, you can see they were under a 4 in 16 and 17, so that management labor number had shot up a good bit. And really, history looking back, they now realize that they kind of let executive salaries of their leadership team get out of hand, and probably need to have some moderation. So they weren't, once again, we hold management labor accountable to contribution margin. So you can keep paying more and more management labor, but I'm going to take management labor times 4 and say, okay guys, if I'm going to pay you this, here's how much contribution margin we're going to get. So if we can't go get it, which one are you going to go? Because I can't keep spending it. So we got to have some output. It's great that you got a wage survey and you want to make this amount of dollars. I got to have this amount of output. I have no quibble about the dollars. What I have a quibble about is the output, because we can measure it. And actually, management labor efficiency ratio, to be quite honest, has probably been the most uncomfortable number most of our clients have to deal with, because it's management. And I'll tell you this: if there's one ratio that's probably more important to get right, it's your management LER, not your direct LER. Because if your management's doing their job, direct labor does theirs. It's pretty simple. So that's the part that makes management teams, when we share this data, squirm a little bit. So the key is this business grew 700,000 to 10 million in 5 years. Pretty phenomenal, but just a great business. They identified, they knew what their catalyst was. For some of you, it's going to be labor. I got to add labor to add capacity. It's some of you might be an equipment-intensive business that it's a new service truck. And for every new service truck is an economic unit of activity. It may be adding a new line of business. It may be adding a new location. Now we've got clients in retail that they've got 5 stores and they're actively looking to launch their 6th store. So they have that idea, like the Pete's example of, hey, here's what my capital investment is to go launch the next store. I just got to find the right location that I believe there will be enough customer demand for me to do. They established the return on investment, and they had our consultant to hold them accountable as they continued to put that money into it. And they were readily accepting of the year that they screwed up, and they adapted. They didn't just keep spending because, oh, that's what we did. And they adapted. And then the key is, obviously remaining profitable through the whole process. So how can you apply this? Because you probably have grown your business intuitively from this, but you may not have had this thinking framework. And so this is how you do what we call an extractive analysis of launch capital. So this is a client of ours that we were doing a call with about a year ago, and we were looking at their profitability. So they had $7.5 million flat for year 1 and 2. Year 3, they'd gone up $500,000, but their profitability had steadily gone down. And so they're thinking, oh man, I thought we were doing good. And they really were doing good, they just couldn't see it. Because in this particular case, they were expanding their facility, but the expansion wasn't open yet. So I said, okay guys, I understand, I sense your frustration looking at these numbers, but they're not telling you the full story. We got to look deeper. So I said, now, the first thing is, we've been talking to them for a couple of years because their top line had stagnated, that, hey, you probably need to address price changes. You're not charging enough. And there's things that you can charge for. You need to really look at that and up your prices. So they upped their prices, and so they upped their prices on July 1st. And then, so the first clean quarter of the new pricing, you can see we've got the best ever quarter of revenue and contribution margin. So $2 million instead of those previous quarters at $1.7 million. So we can validate, so this is, we know at this point causation. We raised prices, which caused revenue to go up, which caused margin percentage to go up. It fell through. It didn't just, all those costs weren't variable. We had to, when I changed my price, there's a lot of those costs that don't vary. You had a question?
Yeah, where does R&D labor fit?
It depends. If it's kind of one-off R&D, it's going to be below net operating income. I look at it as a launch capital investment that's not part of operations. If you're doing constant R&D, I'm going to put you in management labor. You're not part of the operating part of the labor. I want you to be in management labor because you're always kind of tinkering with stuff. But if I have my core R&D team, and then I find something I'm going to add budget dollars to, I'm going to take the expansion of the team, typically an outside contractor, I'm going to put them below the line as a use of profitability in launch capital. So in this case, as you can say, we look at that quarter ended September, and we said, okay, this is the pattern going forward. So we're going to take that rolling 3, and we're going to annualize it. Take it times 4. So their true profitability run rate is now $4.8 million a year contribution margin instead of the $4.25 that they saw for the rolling 12. So they fixed that problem. So now let's look at operating expenses. So in their operating expenses, we realized that they had spent $423,000 in their facilities for the new building that was still in progress, that was about to be open. So we got to take that piece out. That's launch capital. That's preparing for the next thing. That's not what we're doing presently. They had $97,000 in pre-marketing for the new facility that they were preparing, materials and things for the launch. Got to take that out. They added $120,000 of advanced management labor being trained to operate the expanded capacity. That's not part of current operations. They had $50,000 in consulting fees from people helping them do it. So $690,000 was this expansion spend. So what we do is say, instead of $378,000 in net operating income, the real economic run rate of the business is $1,312,000. That's a vastly different story than what you're looking at on your P&L, right? But you had to go through the steps to extract the things of what is embedded in my P&L currently that isn't necessary to run my company today. And I've either got to extract it and put it in its own column, or got to take it out and put it below net operating income. Pick one of the two, but I must keep my sight on the normative operations of my business, of what it takes to run what it's doing today. And so then, I don't want to lose sight of the fact that we've invested $690,000. So what that means, 50% of that number is $345,000. So we're on a current net operating normative run rate of $1,300,000. We're investing $690,000. 50% of that is $345,000. So we've got to increase profit targets by $345,000. So now you can see their new profit target is $1,657,000. So they did $2 million in profit, actually, after this happened. So I think they did all right. They knew what they were doing. But they were getting discouraged because they were seeing traditionally displayed financial data that didn't tell the story. And if your data doesn't tell a story, you got to work on why is it? And I would say 9 times out of 10, it's launch capital distortion that's causing it. Assuming that you fixed your distortion of your compensation and those things that we talked about in the first book. But this is the most common distortion of operating activity. Because once again, if you go to sell your business, classic thing is, we got to do adjusted EBITDA, right? All this is adjusted EBITDA calculation. You're saying, if I sold the business today, this is the stuff that I spent money on that really didn't matter, and this is what the true EBITDA is. It's essentially the same thing. But here's the question. I can argue and get back to that number, but the part that we don't do a good job of is saying, well, we spent $500,000. What were you aiming to accomplish with that? And it is amazing how many of our clients that we go through this discussion with now that we have a framework to talk about it, that don't do, they're planning to spend $500,000 on something. Says, well, you realize that you got to produce $250,000 more profit a year to make that a good bet. Oh, that's not going to do that. Says, well, then why are you spending it? And getting them to stop making bad investments and only go after the good investments, it has dramatically affected, I think, their thinking and their profitability. It actually has helped them grow faster because they're not making the bad choices that kill time and resources.
And so for those businesses, you know, several of our clients have launched direct-to-consumer because of COVID and are having to invest in labor
Yep.
to help with that. Is that also considered launch capital, the investment in the labor?
No, because it wasn't necessarily the catalyst, you know, that it's a reactionary cost. So the idea is, what was the catalyst? You know, did I have to buy facilities? Did I have to spend money to go figure out the market? Was it available to generate the first? It's all the costs that I spent until that activity broke even. So once again, it's the idea, like I said in Pete's example, what was his opening cost and operating losses until it broke even? So that's really what you're going to do, is you're going to do a calculation of saying, how deep in the hole do I go before I've got my money back? That's your capital investment of a new type of endeavor in that process. Okay? All right. So, launch capital, takeaways, you know, the idea is, I really think the key is identifying the discretionary spend, and then also know, in this case, that sometimes rolling 3 tells a more correct story than a rolling 12. You got to kind of be able to interpret the data. You know, if I'm a non-seasonal business and I'm pretty consistent 12 months out of the year, rolling 3 is a great tool to tell you the trajectory of your business. We've had businesses that we've had through improvement programs that, you know, we go through each of their lines of business and all their segments, and we look at the rolling 3s compared to the rolling 12. And if the rolling 3 trend ratios are better than the rolling 12, that is your forecast of where you're headed. When the rolling 3 is equal to or less than the rolling 12, that's telling you that, hey, you've gone as far as you're going to go in that improvement cycle, and you got to come up with something else in that process. And so the idea, the key here is quantifying, and as I said, you either extract it and pull it in its own column, or you take it and pull it down below the net operating income. Now, the challenge is accounting systems aren't designed to keep up with this. So the nice thing is, in our model, we're able to actually keep track of this, and we can allow the costs to sit in their native category, but then we can do model manipulations to move around that information to pull it out of the OpEx piece and pull it down below the line. And so it gives you a cleaner presentation, you know, what's happening. Now, you know, granted, you're not going to do it for an insignificant amount of money, but anything that's probably a $50,000 or higher bet, you probably do want to do it for. All right, so we're going to kind of finish up with some segment analysis here, you know, for the last piece. And so it's great, you know, when you're looking at your business this way. Let's get back to this one. When you're looking at businesses, this way, I mean, it's the business in total. Well, granted, there's a lot more stories to be told. I mean, if you're a manufacturing business, you're probably not making one thing. You know, you're making multiple things. If you're a sales business, you got multiple channels of things. You've got channels that you sell through. You've got SKUs. You've got product groupings. You got all kinds of manner of segments in that one. Services business, you know, you've got different offices. You've got you know, types of services. You've got by person, by customer. So all these businesses have segments, you know, that you can look at. So we get back over here. So when you look at this kind of array of segment accounting, there you go. So common segments, line of business. So like in our business model, for our office in Huntsville, with the firm we're now a part of, Carr Riggs, you know, we have 4 lines of business. We do consulting, we do tax, we do opinion financial statements, we do what we call accounting solutions, where we do outsource controller and bookkeeper services. And those are the 4 main lines of business. We have very little overlap of people doing those services. They pretty much stay in their segment. But we can look at profitability by line of business. I can look at profitability by customer. I can look at profitability by team. We can look at profitability by location. You can look at profitability by product or project, as well. But the key here is when you're doing segment accountability is we're not trying to complete a full P&L. That's overdone. I'm an absolute anti-allocator. If you're having to allocate something, you got to stop and really think, is this actually worth it? And 99% of the time it's not. It's something accountants do, and it takes up a lot of time, and it just distorts stuff. It's like taking peanut butter and spreading it all over your P&L. Well, you lose the sense that it used to be a peanut. Well, I can count a peanut, I can't count peanut butter. And what most people really resist, I learned this as a young controller for a bank that I was working at before I had my firm, and I did the first ever branch profitability report. And I dutifully did what I was taught in college, of you take all the costs and you allocate them out, and I created a nice looking P&L for every branch. And all the branch managers were squealing on, I don't have anything to do with that cost, and why is that on there? That doesn't make sense. And they were right. Their intuitive sense was absolutely right. So I went back and I redid it, and I ignored anything that was a corporate cost, and I looked at just their individual directly associated cost of their branch. And because it's a bank, I had some branches that were deposit generators, that they generated more deposits than they generated in loans, and I had some branches that were more loan generators that needed the deposits of those branches that were deposit generators. So the guys who generated loans, they had to pay a cost of money to the branch that generated the deposit, and vice versa. After I did that, everybody said, hey, this is great. And we actually had, for the first time, a very clear understanding of who produced what margin, an operating margin by unit. Yes, the sum of the operating margins by unit had to cover corporate overhead, but it made no sense to take corporate overhead and spread it out to all the branches, because it's the sum of all the branches that had to overcome the overhead. It wasn't that if a branch went away, corporate overhead wasn't going to change. So we have a common principle that you'll hear a lot. We'll say, we call it the turn on, turn off principle. So when you connect a cost to a stream of revenue, you have to look at that cost and say, if the revenue goes away, does the cost go away? And if it doesn't go in there. It goes someplace else. And that, to me, is the cleanest way of looking at segment accountability. But I'm only primarily looking at 3 things. So the way I would explain it is this. Level 1 segment analysis, revenue and cost of goods sold. That if I can get revenue and cost of goods sold, that means I can get gross margin. So that's the simplest form of a segment. That's still useful information. Level 2 is, can I get revenue, COGS, and direct labor by that segment? That's even better. Now I got all the way to contribution margin. Now, if you're in a location-centric business, then you can go almost to another level of management labor and some operating expenses for that segment. And so I can get down in the operating expense section. That's not all operating expenses. It's just the ones directly associated to that operating unit. And so that's kind of level 3 in that process. But here's the better one. Level 4 is I can get all of those connected P&L items, but I can also reach over to the balance sheet and I know the accounts receivable, inventory, and accounts payable and deferred revenue for that segment. And that is enormously powerful. That's actually the number that everybody needs to know, but accounting systems do not easily produce.
And does WIP get thrown in there?
WIP would be the same as accounts receivable. WIP is just unbilled accounts receivable, so that, to me, when I say accounts receivable, I include WIP. So here's an example. This is a mechanical contractor, and so we have quite a few clients in this industry, so this is kind of a composite of a couple of them. And so they were doing $3.5 million in projects, $2.9 million in recurring, and $1 million in construction. So they're feeling pretty good. Hey, we're a $7.4 million business. Well, you know, all that revenue is not equal. So if you look at the projects, it's a contribution margin of 31%. If you look at the recurring, contribution margin is 63%. If you look at construction, 15% contribution margin. I'd say those aren't all equal by a long shot. And you look at labor efficiency. We get 222 labor efficiency on projects, we get 379 on recurring, we get 250 on construction. Gross margin percentage, only 25%, and this is common in construction. You got a lot of pass-through. You're just really kind of the guy with the pickup truck, and you know, so you're getting paid a little bit. So when we looked at this, we said, when we talked to the clients, is at the end of the day, we think you're underpricing your project work. And we think you're underperforming on your project work because your staff sees it as filler for your recurring work. Because that's the easy, you know, go out and do the recurring contract stuff. And so we challenged them on their pricing and their project management. And so we got them up from a 222 project labor efficiency to a 284. Great. Just by them seeing how much lower project work was, it's like, guys, why are you giving this away? We may not even need to do it if you can't get any better than this. So that moved them from 31% contribution margin to 37. So still a little ways to go, but certainly an improvement. The other thing was, because recurring work is your prime profit driver, you should only do projects and construction that lead to recurring work. Stop doing stuff that is revenue, but it's low margin and it's a commodity. It does not lead to ongoing things. Probably not worth your attention, because it puts you in a situation that causes you to manage those things differently than what your really prime directive is as a business. So when they changed that, they also, you can see that they mostly went up in projects just from price increases, not really from anything else. And then construction, they dropped half in construction because they only focused on the construction projects that would lead to a recurring service work in that process, because it was really the lowest margin in that process. So they went from 7% profit to 13%. But here's what really matters. So as I said, that level 4 of analysis is, look at this down at the bottom. Project work, AR, DSO, day sales outstanding. They generally have to wait 45 days to get paid for projects. They generally get paid within 5 days each month for the recurring contracts. They wait 75 days for construction payment. Why would you want to do 15% contribution margin work and wait 75 days for it? It better have another value, or else, you know, I'm saying, they ain't doing that. Either they fix the terms or you walk. We had a landscaping client in Omaha that they had a big contract with a tract home builder, and it was their biggest customer. And I told them to fire them. I said, listen, guys, you say this on every call that your guys are getting beat up by this housing developer, and it's low margin work. I said, listen, if you fire them, you may drop in revenue, but I think your margin's going to go up. So they finally took about a year to convince them. So they finally fired him. He will tell you this is the best decision he's ever made in his life. I mean, they have taken off ever since that, because his best people were getting sucked in to their lowest margin work. You cannot let your best people get pulled into the worst margin stuff you're doing. You've got to protect them. And that's really what this case was. The only construction projects that they kept were the ones that they got it from, and once again, they went from 75 days to 60, which is still not great, but it's better because they just held firm on their terms. Said, listen, if you want to do business with us, here's the deal. You don't want to do business with us, fine, because we don't really need it. We're doing this to help you, but this is how we work. And if you really kind of stick to your terms, it's possible that it can be done. AP days stayed the same. But notice this, so here's your net trade capital, 308,000 to turn over 3.5 million. I got $6,000 that turning over 2.9 million of revenue and $1.8 million of my contribution margin. I basically have zero cash constantly invested to turn over my best margin line work. That's an important thing to know. And then you stop doing the one that's really bad, or else change the terms. And when enough people say no, the market changes. When the MSPs, when the managed service providers started doing it to, instead of doing what they call break fix, if it breaks, they come and fix it and they send you a bill, they got away from that and started doing captive monthly service agreements. That industry took off. Now, it took a few years, it's been about 30 years in the making, but it took quite a few years before the marketplace realized that it was better for both parties. And for them to just pay a per seat or fixed monthly engagement amount. And it's really worked out best. I mean, we have far better IT support now under that methodology, than we've ever had before. So key points: recurring service units, key profitability, high cash flow, and project work is good, but you got to price it good, you got to manage it, and you got to be willing to walk unless it really supports the recurring segment. And the construction division, I mean, it's just questionable. It's high revenue, and people go in that because of the revenue. It's like, stop it! It's not the important number.
Hey Greg, question on the return on invested.
Yep.
From earlier. Is the period that you're measuring return on always 12 months? Because, like, what about a business like property management where clients you can get from marketing will normally stay for 5 years?
Yeah, I'm not a big fan of the multi-year calculations. I mean, it's okay to run those as secondary, but I look at them as, I'm not a fan of the lifetime value of a customer concept. I've seen more people try to distort those to make a point, and I've not seen it as a valid presentation myself. I mean, so somebody else has, great for them, but I look at dollars. And so I look at my prime marketing measure is contribution margin dollars per marketing dollar spent on a rolling 12 basis. And I want to look at a broader trend of your marketing effectiveness is to me a better way of looking at it. And then for the targeted special push spends, then I want the return on invested capital concept. All right, so this is a location example. 4 retail stores. Now the green represents the best number for the 4 stores for the whole company. So you can see store 1 has the best gross margin, store 2 has the best revenue, store 3 has the best direct labor efficiency, and so forth. So in data, we blindly say, oh, well, let's create the optimal example. Let's take the best of all of them and create the optimized version. So what we really want is $1,350,000 at 48% at $388 and a 14% profit, and that'll produce the best ever. And sure, that will produce it. It just won't ever happen because there's reasons why each of those. Now you can learn, and if you can replicate why somebody else is a better ratio than you, okay, we can learn from that and we can match that pattern. But some of these are just intuitive to how that operation works. But the more important one is look at the store number 4 that don't have any green at the top, but they have the best, more important number at the bottom. They have the best return on invested capital. This is something that retail just they do not get this through their little head. That's the magic number. We had a retail chain of 75 stores that was in the outlet sector. And the most money they ever made was when they abandoned their million-plus stores and started focusing on remainder stores only that were doing the $400,000 to $600,000 revenue stores made more dollars of profit than their stores that were doing $1 million of revenue. It's just the way it works. The $1 million stores were in too expensive of places. They had expensive rent. They were more expensive to operate. So, Now, I've heard this, I haven't looked at the hard data, but I think it's a pretty fair statement. From what I understand during COVID, McDonald's is at an all-time high of profitability. Now, have you been by McDonald's to see how they're operating lately?
No, drive-through.
All drive-through. Remember the little company I told you about earlier, Pal's Sudden Service? McDonald's has become a bigger version of Pal's Sudden Service. They didn't have indoor seating. It wasn't profitable. What they did was have a highly efficient. Now you don't get through the drive-through in 36 seconds at McDonald's. I guarantee you that. But they did another thing. They limited their menu. Now, have you noticed one other thing? Have you seen the deals? They're not running deals. They don't have to run deals. Why do you run a deal when the drive-through line is full pretty much all day? I don't need to run coupons. Pal's does not run any deals. They don't have any coupons. They have a one-page menu that's pretty much been the same for about 10 years. It's what their customers want. And McDonald's basically took a page out of Pal's and did exactly that, and they're making more money than they've ever made. Because they kept trying to increase revenues and they lost sight of the more important thing, profit. Do the things that people need, do it exceptionally well, it'll serve you well. That's a pretty simple concept. In this case, I don't want multipliers of store 1 and 2. I want every store to be like number 4 because I get a 68% return on invested capital. Simple as that. I got less money invested, and simple question. Is it easier to produce $1.3 million a year in revenue or $850,000? Which do you think has a higher probability of being more consistent as a percentage to that target?
Are you asking me?
Yeah. The 850. Exactly. It's like, and there again, this is why the subtitle of the new book is called Smart Scaling. Because it's like, the money guys are going to look to these first 2 stores and say, oh, let's scale those. They're the ones that are going to put those in their forecast and say, oh, let's turn this into a 50-store chain. No, I want to take store 4 and turn it into a 50-store chain because it's more likely to happen. And it's a better return. It's just dumb. So here's kind of my I'm sure I'll get comments.
Good.
Yeah. So, well, and these are things that, you're taught stuff in school, and there's a little voice in the back of your head going, this doesn't make sense, but I guess these these are obviously smart people. I mean, they're college professors, they're big partners in accounting firms, they're successful business owners. I mean, there's a lot of businesses out there that, they're not Ponzi schemes, but they're really close. The idea of a business that's never made a profit and it's worth a lot of money, there's a great Saturday Night Live skit that's actually on YouTube. If you go look it up, it's called First National Change Bank. And so anytime that you're talking to somebody who has a high revenue business and no profit, so they did the skit and they said, we're a change bank. I mean, we're here for you. 4 quarters for $1. The guy says, well, how do you make a profit? He says, volume. No, it's not how it works. So this is, when we talk about we think labor productivity is obviously a key thing. So a couple of things on that topic, before we wrap up, is A-player grid. Most people originally do this as 4 quarters and 4 quartiles, and the upper right is a cultural fit and a productivity fit, and the upper left is culture fit, but probably low on productivity and so forth. The bottom right is high productivity, low culture. That's called a terrorist that some of us have in our organizations. Bottom left is an obvious quick fire. Well, we really kind of refined this to say, really, and we believe in A player is they're an 8 or above in productivity, but you got to be able to measure that. And it's not going to be even for everybody. I mean, I got all range of skill sets in our firm, and not everybody produces to the same rate, but they may be producing to a high rate for their role. And so I got to be role specific in those targets, but you got to spend some time doing it, but it's doable. And then same thing on culture. If you're not an 8 or better on culture, you're not an A player. One tick down from that's a 7. I think that's a B player. Everybody else, you know, you need to kind of have that plan of saying you need to work someplace else. Now, that's really difficult when the labor market's tight. And a lot of us accepted a lot of substandard labor, you know, pre-COVID. There's a little window of opportunity right now to upgrade your staff. You know, so I think, you know, that's really kind of where, you know, Bill will help you, you know, find those people and get those people in place. But it's going to be a window that closes pretty quickly. So if you're in the staff upgrade mindset, you better move fast. This one is probably our most favorite graph that we get requested all the time. It's called the career labor efficiency curve. And this is the uncomfortable thing that we don't want to have the discussion with our team or in the public discussion matrix, but it's a personal belief of mine that you're not going to get me to change. Number one is when you first hire a person is the first and only time that person should be paid above their productivity. So the green line is their pay, the orange line is their productivity. And as soon as productivity crosses over with pay, that's what we call the chasing zone. And the reason why I call it the chasing zone is I believe in appropriate compensation management is as an employee produces, their pay should chase that performance. Now, I will tell you in today's labor market, you better chase faster than every year. Probably for your top performers who are developing rapidly throughout your organization, you probably need to be thinking about at least every 6 months of reviewing their compensation and saying, do they need a bump? Do they need a bump? Now, keep in mind when it comes to labor efficiency, labor cost goes up in 3 flavors. I can give a raise, I can add a body, I can pay a bonus.
Right.
2 of those are the gift that keep giving.
Right.
And so we think bonuses are recognition of unsustainable performance. If I am not convinced that your above and beyond effort is unsustainable, then I'm going to give you a bonus. If I'm convinced that you've attained a new level of sustainable performance, I'm going to move your salary to that level. Might give you a little bit of a bump as well, you know, in that process. It's hard to know, but how many of you have given out a raise to somebody after a year of exceptional performance only to have them drop back to ordinary performance after the raise? That's the painful process we've all experienced. And that's because you misaddressed the performance. Is it sustainable or not? Now, you can always give a bonus, and if they later continue to sustain it, you can go ahead and, okay, you've now been doing it 18 months. Okay, we can bump you up. Good deal. But the person that wants a raise just because it's the market wage, but their performance doesn't meet that wage, that doesn't work. And this is the problem with the chasing zone. It chases for a period of time, but there's eventually, the Peter principle is quite real. We all achieve our level of incompetence at some point, and you cap out. You just can't produce anymore. I mean, it would take an extraordinarily disruptive thing. And sometimes people do it to themselves. They quit learning, they quit developing themselves. There's times that we fail as organizations of not pushing them to develop themselves. Those are all important things in the human development process, because I don't believe it's an age thing. I feel pretty good. You know, I'm in my early 60s, and I think I got another good 10, 15 years in me, because I like what I get to do. And I'll take on any 30-year-old that wants to go toe to toe.
Okay, Jess.
So if we're as long as we're working in my field, I think I can compete. So it's not a question of time. It's just more so people run out of range of production. And then you get to the uncomfortable piece, which is when it flips again, it's called the replacement zone for a reason. Your organization cannot afford to keep that person. I don't care how much you like them.
Right.
And and there's tons of businesses that promote a mismatch of culture to productivity. And you can have all of these glowing statements about, oh, we're a family, and yeah, we're going to do all this great stuff. And you can do that. But pay throughout the cycle has to be relative to performance. Now, the firm that I'm now part of, Carr Riggs, they've addressed this. There's a point that I can still work, and I can just choose to work less. But I'm going to make less. And I'm perfectly fine with that. It's already defined. There is a standard of what I have to produce to. And I'm perfectly good with that. But most of you have not addressed that. And so you have to look at that. And sometimes there is just a better place for somebody to move on to, or you've got to kind of find a way to bend the salary curve with that drop in productivity, or else you're going to have a problem. Sports deals with this a different way. I'm a huge Red Sox fan, even though I'm from Alabama. For some reason, I've always loved the Red Sox. I remember I was a big Carl Yastrzemski fan when I was a kid growing up. And so in baseball, they have their labor efficiency ratio is called WAR, wins above replacement. So Jason Varitek, been a captain and a great catcher for the Red Sox. You can see green is his contract, and you can see orange is his wins above replacement. So his contract matched it, and so right there in 2004, at the peak of his wins above replacement, that was the year that they broke the curse. 86 years they had been waiting to win the World Series. And so what happened was Jason kept signing contracts that had escalation clauses, and he had another good year in 05, but then from 05 he had some injuries in 06 that really dropped his productivity. And but there was hope that he was so beloved by the team that he'd come back, and they kept his salary up, and he never got back. I mean, so that gap between the green and the orange there in the out part, if you're an operating business, that's called losses.
Yeah.
And it's not losing games, it is losing games because you got somebody taking up a slot on the payroll that isn't producing. So we did some work in the auto service industry, auto service industry, I give them credit. They have a standard pay rate by service. Now they've always got to pay minimum wage at a minimum, but they're almost always going to be above minimum wage. But they pay people, if they got a technician that's doing an oil change, well, there's a standard price of compensation that they get paid on a piecework basis rather than an hourly basis. But I was having a discussion with one of my clients in that industry the other day, and he was talking about he had some underperforming techs. I said, well, listen, I get it that you got a correct labor efficiency ratio to that tech because of the revenue that you generate to what you have to pay them. You got that piece wired. Here's the piece you're missing. That person is taking up a productive slot that's underperforming. It's not about the labor efficiency ratio as much as it is how much gross margin can a tech produce in a day. That's the important measure. And if I've got an underperforming tech, he's holding me back from that process because my overhead didn't change because he did 2 oil changes instead of 6. And see, most entrepreneurs are trying to connect, oh, that person didn't hurt me because I only pay them when they do this. No, they are hurting you because their throughput is holding back the organization. As I've said earlier today, it is about the speed of margin from the beginning of the transaction to its completion is where you win the game at. And if I can get that transaction to move faster and complete faster, everybody wins. It's when things get stretched out is where things get dysfunctional in your business, in the marketplace, and so forth. So last piece, we'll give you more of a labor concept example. So this is a case study of a business doing $4.5 million to 5.4 to 6 million And this is revenue by team. So this is just basically from their timekeeping system. So one of the things that our system has, the one we had before, and also the same system that we have with, it's a different system, but it does the same thing with Carl Riggs, is we can measure the revenue by person after it's been written off. So simplistic timekeeping systems like Basecamp and Harvest and those things, yeah, you can get time, but you're not getting the adjusted time that actually made it to an invoice. So you got to be really careful when you're looking at time analysis if the underlying timekeeping system isn't sophisticated enough to allocate the write-offs. So in this example, you're looking at the project work saying, oh man, project work is, we're killing it. That scheduled work, it's okay, it's kind of good filler. And then the fixed price work, it's not as good as the project work, but man, we got to keep those project workers. Those are our lead dogs. I mean, they're making things work. Well, if I actually look at it and look at write-offs, all of a sudden, the project work, if you look down at the bottom, instead of 3.4 million, they had 1.3 million of write-offs. I had very little write-offs in the other two. So if I'm not connecting billing adjustments to the labor that the time was kept at, I got a false information. And so now I'm looking at it with a completely different picture going, well, they're still the highest, but yeah, we need to work on that, okay? Still not enough. Next thing you look at is what is the compensation by team. So now here's my project work at $2 million, the labor is $1.1 million. It's this labor efficiency ratio. So you can see the project work is 1.81. I can tell you from most professional service companies, if you're not at a 2, not good. Staffing industry is going to be lower than that, but when you're actively managing productive labor, it's generally a 2 up to a 2.5. I will say that most creative agencies, are probably 2.75 to a 3 is kind of where I like to see those. You got a little more non-billable time in between projects. But you can see the scheduled work is functioning at a 2.21, so that's good. The fixed price work is at 3.16. So Jack Welch famously said back during his tenure as CEO of GE, when they were actually a good company, and he said, why do I want to limit myself to 6% profit so that they got out of cost plus work? They only did fixed price for government contracts. And it's for this very reason. They felt good about their team's ability to perform based on a fixed target. And this is the power in the sense of figuring out how to do fixed price work. Here's the thing, anybody that's listening to this, if you bill by the hour, there's only 2 possible economic outcomes. You either give away your expertise or you charge for your ignorance. You never hit the economic equilibrium. It's a weak methodology of lack of scoping. And if you know how to scope and if you know how to manage, you don't have to bill by the hour. Now, in certain industries, it's just a hard-coded way of doing business. We've broken through that with our consulting practice. So all of our consulting projects are all fixed price. 1% of the stuff we've only had a few rare things that we just couldn't guess at how much time it was going to take, and the client was fine with it. But most of the time, we're going to say we're going to carve out from this point to this point. We can tell you how much that's going to be, and then we'll reset after we get to that point. And I think that's the right way to do business for everybody. Customer gets certainty, you've got a target to go hit. I got a chance to make more money if I'm good at it in that process. But this is huge, because when you get to the point that you have this type of understanding, that lead dog of project work that you thought was the best work, it's far from it. It's a dumpster fire waiting to happen.
I'm just aware that we've only got a few minutes left, so I'm just trying to survey the group to find out if there's additional
That's what I did.
questions, clarifying questions.
So that was actually the last slide, so I'll get
Yeah.
Perfect.
For Greg, I just typically mentioned.
Landed the plane on.
So Maxon says that he can attest to your productivity guru.
I can vend my own.
I do actually want to give a shout out to Mike because he's been helping me to manage the chat line a little bit. Any additional comments or questions before we're wrapping up here from the group? You've completely blown them out of the water.
Yeah.
You're gonna have to watch this 4 times.
It is, it is one of those things that you do have to, it's interesting how many people do find that once they hear my material more than once, that it really is that thing that you gotta listen to it, you gotta try to go apply it, come back and listen to it again, refine how you've applied it. But it is the consistent application of it that actually it causes a lot of people to really change the outcomes. And it's one of the things our team really gets stoked on of seeing, our clients. I mean, the client that went from 700,000 to 10 million in 5 years, that's not a one-off thing. I mean, we've got other people who have accomplished the same things, and we've seen companies come back from the brink of disaster, and those are quite rewarding to see people do that. So.
Well, so a couple of follow-up items. So for both those of you that want to do Financial 101, Greg recommended a YouTube website.
Yeah, so one of the companies that we refer some outsourced bookkeeping to, a company called Ignite Spot.
Ignite Spot.
Yeah, Ignite Spot. Eddie Hood's the founder. Eddie's he does a lot of YouTube videos that really, he does a really good job of explaining, some simple, basic financial concepts. And we really like them even though we do some of that work. I mean, they're really good with the clients we share with them that are, if you're at QuickBooks Online, that's the only platform they work on. But we've been really pleased with them. There's another company, Bernice Parsons she's out of Hawaii, but she uses labor in the Philippines. And so probably some more heavy back office stuff. Bernice is another good one. That we recommend for those kinds of things, but yeah, those are things that just kind of getting through some of the basics. But it's less about learning terminology as it is just working with it. You just got to make you as the owner of the business need to own the financial data. You can have other people prepare it, but it is you owning the analysis of it and forcing a repeating rhythm of looking at it in that process.
And the other resource, again, I put this in the chat, but just going to the Simple Numbers website, there's downloadable templates, there's videos.
Yeah, actually on the simplenumbers.me site, we did a crisis management page back during COVID that actually has a simplistic forecast model that you can go use. So there's videos that we shot on how to use that model if you're in a do-it-yourself mode. And so it uses this same trade capital and infrastructure capital concept that we went over today to help you forecast the balance sheet as well as the P&L, and in a little more functional way, I think. So.
And then, so Daniel Craig had just one more question. If I can get customers to pay on the first on a fixed price service business, is that what you're talking about in terms of getting my customers to fund the trade capital?
Yes.
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 Yes,
it's not about billing on the first, it's about collecting on the first.
Bravo, says Eileen. So you got a shout out.
Yeah,
all right, we will be wrapping up. Thank you. Can we get a round of applause? And thank you again to my live stream team. You guys are amazing.